Oh, Ryan just took over and is recording. Actually,
that was easy enough.
Ryan, why don't you? Can you just pause the recording?
Yeah, that's what I was gonna do until we get going.
Kick that in.
There we go.
Awesome. Okay, so welcome back, everyone. We are now we're now shifting our focus back into what is taxable income, what is not. And again, I've kind of recapped this a few times. I recapped it again at the end of the last session. We started out the very beginning of this series of classes for part one of the EA by discussing what are some of the basic information that you need to collect to do a tax return. And then how do you apply that to determine what filing status someone is going to use, whether or not they can claim someone on their return, whether or not they have to file a return or may want to file a return. Once we finished that, we pretty much went...
Oh, find the SiriusXM app.
Thank you, Ryan.
You're welcome.
Once we finished that, we started talking about employee compensation and what would be taxable or not taxable, and I gave you that handout that was called the federal income or not. Then we took a diversion for about 3 sessions to talk about basis, depreciation, and capital gains and losses, mostly is what we were discussing. And we had to do that because then we could start talking about other types of income that may be taxable, such as what we talked about the last couple of sessions: self-employment, rentals, and then, of course, we discussed just for a little while about flow-through entities. Now what we're going to do is we're going to shift our focus directly onto what else goes on to the tax return. So does everyone have a copy of their tax return, hopefully printed out, because I would like everyone to just glance at it for a moment, if you can. So everyone that's on the webinar with me, Garrett, Noemi, do you guys have your 1040s up and look so you can look at it?
Yes.
Okay. And Garrett?
Yes.
Excellent. Okay, cool. So look at page 2, line 1. What is line 1, Noemi?
Wages, salaries, tips, and others.
Okay, perfect. What is lines 2A and 2B, Garrett? What are lines 2A and 2B?
2A is tax exempt interest. 2A says tax exempt interest. 2B is taxable interest.
Excellent. And Noemi, what are lines 3A and 3B?
3A, qualified dividends. 3B, ordinary dividends.
Okay. So lines 1 through 3, we discussed pretty early on when we first started talking about taxable income or not. Okay, and that's when we stepped sideways and started talking about basis, depreciation, capital gains and losses like from sales. And then we talked about self-employment income. So everybody go to on the Form 1040, Schedule 1 of the Form 1040. And let me know when you're there.
Schedule 1. I'm using my tax return from last year, so.
That's okay, as long as you got it so we can look at the lines. Yeah. How about you, Noemi? Do you have it in front of you?
No, only the 2 sheets.
Okay, why don't you take a moment? You're on your computer, right? Why don't you take a moment and pull up a copy and maybe even print it if you can. Why don't you pull up a copy just off the internet? Because we want to make sure everyone has a copy of Form 1040 and the Schedule 1 right now.
Can you have us download it?
Let me see here. Hold on a minute. Just my copy isn't the best that I've got, but I'll share with you what I've got. So give me just a moment to get to it. All right, there you go.
Okay.
Now, are you able to print that out, Noemi?
Yes, I can print.
Okay, why don't you print that out? Then let me know when you got it. This is pretty important stuff here. Let me know when you have that, Noemi.
Yeah. Sorry, I'm print.
It's okay. It's
print.
okay.
Okay, I'm printing it now.
Okay, I'll wait till you get it. Okay.
Yeah.
Okay, got it.
Coming out.
So,
Yeah.
okay, so here's the reason I paused is because we just finished talking about self-employment. Where on Schedule 1 would you report self-employment income or loss?
Well, business income or
Or loss? Yeah, that's exactly right. 12. Where would you attach any capital gain or loss? And remember, a capital gain is something that you sell something like your house or something that you personally own, and you have a gain or loss from that. Where would you report that? What line?
13.
That's exactly right. And then where would you report rental income or loss?
Line 17.
That's right. Where would you report income or loss from a flow-through entity?
Line 21, other income.
Nope. Look again. It's a good guess. I get why you got that because line 21 is kind of the catch-all line if it doesn't fit anywhere else. What schedule do you report income from a Schedule K1 usually on?
Okay. Yes. Line 17.
Hey, wouldn't it?
It's line 17. You're right, Noemi. Look at line 17. It says rental real estate. That's the one we're most used to. But it also talks about royalties, and look what follows that. Partnerships, S-corps, trusts, etc. attached Schedule E. Remember how we said that when you have a flow-through entity, the stuff that gets flowing through to the individual tax return is reported on a Schedule what, Garrett? Do you remember the name of that?
It's a passive income for Schedule, supplemental income for Schedule E, isn't it?
Well, yes, it is. That's the name of it. But what if you and I are running
Schedule K1?
Yeah, there you go. If you and I are running a partnership and we need to pass that through to our individual returns, individual tax returns, we do it with a Schedule K1. That's right, Garrett.
Isn't that Form 1065, if I remember right?
In that
For the
case, yes.
partnership? Yeah.
Yes. But the point is the K1 is what I was after.
Yeah, that's what I thought. So
the K1 gets reported. Your basic income and loss gets reported on a Schedule E. Now, there's other places, some of the stuff from a K1 can get reported other places. But the point is Schedule E is where you report your basic income and loss from a K1, okay? And that's why it's put on line 17 with rental, because what else do you put on there? You put rentals on there, okay?
Yes.
So why are we doing all of that? Why are we doing all of that? Why are we doing all of that right now? We're doing all of this because I am wanting to remind you that we're coming back and looking at just income on the Form 1040. And schedule 1 of the Form 1040, the top half of it reports most of your income. There are a few items of income you report directly on the Form 1040 itself. And that's why I wanted you looking at it. Because when we get all done on the Form 1040 itself, what line do we put total income on? What line number, I mean?
Line 7. No, 6, sorry.
That's okay. 6, line 6. It says total income. You do the income from the lines that are up above, lines 1 through 5, and then everything that's on Schedule 1. The top half of Schedule 1 gets put on, gets added to all the other lines, and then all reported together as a whole on line 6 as total income. And that's what we're aiming for. That's all we're doing right now. Okay? So take a look at line 4A, lines 4A and 4B. What do those say there?
4A is IRAs, pensions, and annuities, and 4B is taxable amount.
That's right. So that already tells you that you can have something like an IRA, and the part on the left would be the total amount. The part on the right is the taxable amount. What does that tell you about the amount being given to you? The answer is it might or might not be taxable.
Taxable.
Fully taxable, right. What is line 5A, Noemi?
Social Security benefits.
Right, that's the total amount. And what's line 5B?
Taxable amount.
Of the Social Security benefits. So that's actually what we're focusing on first. Once we finish that, we're going to go ahead and talk about some of the other income items that you see on Schedule 1. Okay, so we're going to be going into all of that. So I'm going to get ready, share my screen with you. So keep in mind here, this is the federal income or not. Remember that? Do you guys all have that? You want to keep this. So do you guys have this?
Yeah,
Okay.
I have it.
Noemi?
I think my screen again is leaked. What I can see is Microsoft Outlook web app.
Okay. It's federal. What I've got up here is the federal income or not. 3
Okay.
pages that I sent you before. I sent them several sessions ago.
There's also a page that I printed from the reading from chapter 10.
Uh-huh.
It's the last page before it has the study questions for unit 10.
Uh-huh.
That has page 193 in our book or whatever we're using there.
Uh-huh.
It's a table that shows taxable versus non-taxable income.
There you go.
That I got printed out as well for class today because I thought that might come in handy.
Well, all this is good information.
Yeah.
So Noemi, what I've got is that 3-page sheet that I sent, or 3-page document I sent several sessions ago that's called Federal Income or Not. Okay.
Yeah, I can see now.
Okay. Well, I just want to make sure you have it because early on we talked about everything on page 1. And we talked about, and I don't know if it's caught up for you, Noemi, but we talked about interest and dividends, which started us on page 2. Okay.
Okay.
Now on page 2, now we're going to start talking about IRA distributions, and other types of retirement. So we're talking about retirement for IRA distributions, retirement for other types other types of retirement. And notice, for the most part, it's taxable, but there are some situations where it's not taxable. Okay. So this is what I want to do. We're going to work off of this sheet here now. And what I'm going to do while it's coming up for you, Noemi, I'm going to send this out to you because I don't think I have sent this to you yet. It's a retirement plans comparison. And believe it or not, I'm going to be teaching completely from this to teach you the retirement plan. So I'm going to send this to you right now. And I'd appreciate it if you download it and then also print it. Yeah.
Yeah.
Because it will help you. I'm also sending one for Social Security income. So you're getting both of those. They should be to you by now. And go ahead and print those out and let me know when you got them printed out. And let me know when you have those. And to those watching this after the fact, go ahead and get a copy of this too and look at it. And if you're missing it, reach out to me and I will get it to you. Okay. But you should be able to download it also from the website. By the time this is available, this should be available on the website as one of the handouts that could be downloaded.
Okay.
Okay, you got yours. How about you, Garrett?
Wait.
Yeah, I got them.
Okay, cool. Then let's go. So what I'm going to be doing is actually teaching from this very thing that I gave you. But as you can see along the top, we have 3 columns: traditional IRA, the Roth IRA, and the qualified employee plans. Now, these are all similar. They are all retirement plans, okay? But there's a distinction between them with some special rules. Now, I want you to know I'm not trying to make you an expert on all 3 of these, but I do need to give you a lot of information, and what I've done is I've culled it down. You notice I'm not using any of normal PowerPoint presentation. I'll tell you why. It's because I think it's more important I give you what you actually absolutely need to know, and then as you read your book and use some of the information that some of you with some experience already have, and those that don't, you just read the book, you'll start being able to plug everything into what I give you right here. Okay? So let's talk for a moment about traditional IRA. What is a traditional IRA? First of all, what is an IRA? An IRA is an individual retirement arrangement. That is a type of retirement account that you normally set up on your own. There are circumstances where it can actually be set up through an employer, but most of the time, most people set up a traditional IRA on their own, and they contribute money to it, and they get some benefits for doing that that help them save for retirement. Okay, so that's a traditional one. Now here's a Roth IRA. It's still an IRA, just like the traditional, except it's Roth. What does that mean? Well, there is a distinction between the two, and we're going to talk about that distinction as we go through and I teach that. But I want you to know, again, this is another type of IRA, and it's in there. It's available because it's another way to help you save for retirement. And then there are qualified employee plans. Qualified employee plans is a whole group of plans usually offered through an employer. I shouldn't say usually, offered through an employer. They're qualified employee plans offered through an employer. Examples: 401k, a 401k plan, which many people are familiar with. 403b plan would qualify underneath the qualified employee plans. 403bs are often used like by teachers and so on. Okay, so traditional IRA, Roth IRA, employee and qualified employee plans. So this is what we're going to do. We're going to work our way down one column, okay, talking about just traditional IRA to start with, okay? And in each line, there's a question there or a remark there to talk about it. Now, as I go through, because I'm teaching it this way, it's a little different than the way you're used to seeing things presented to you. So if you have questions, just stop me as we go through each one. So the first thing is in a traditional IRA, there's some benefits you get. You put money into this IRA account that has to be set up as an IRA account. You can invest the money however you want, okay? And what I mean by that is an IRA account is just one that's designated or marked as IRA, but you can put it into, for example, nothing more than you could actually have just a regular savings account for your IRA. I wouldn't recommend that because savings account pays you so little interest. Most people take a traditional IRA, they create one, and then they use the money that's in there to invest in one thing or another, like stocks and bonds and stuff like that, to try to grow the account. Traditional IRA, you put money in, and then it grows, and then you get money out when you retire, okay? That's really all it is. So what really is a traditional IRA? It's nothing more than an investment that you have, but it's been marked and declared to be an IRA account, so it gets special tax treatment. Okay? So let's talk about it. First of all, are the contributions, we have contributions there. Are the contributions deductible on your tax return? A traditional IRA, and again, we're only going to focus on this, the traditional IRA column. Yes, usually they are taxable. Now, that means what? That means that if you put $1,000 in, you get to take $1,000 off of your taxable income. So if you had $20,000 of total income for the year and you put $1,000 in, now your taxable income is $19,000. The $20,000 minus what you put into the IRA. So that helps you now, right?
Yes.
Okay. Now there is an exception. That exception happens when there are non-deductible contributions. Okay, that can happen when, for example, we haven't talked about it yet, but let's say you put too much money in there in 1 year, because there are some limits. So if you accidentally put too much money in there, you might actually not be able to take some of the tax break. So I'm going to just give a simple example. Don't worry about the numbers yet, other than to help you understand it. Let's say that you actually put $6,000 in there, but you should have only put $5,500 in there. So how much more did you put in there than you should have?
500.
500. So that 500 is basis to you. You have an investment in that. You have a basis in that. You did not. Why do you have a basis of $500 in that?
Because you paid tax on that already.
You did. You did. Exactly. You're not getting a tax break. If you put $6,000 in there and did not take any deductible contribution, you would have how much of a basis?
6,000.
That's right. But if you take a deductible contribution of $5,500, you don't get to consider that part of your basis in that, because that's you remove that from tax. Okay? So that leaves you, in our example, if you did 6,000, you remove $5,500. You didn't remove it, but you took a deductible amount on that. What's left over is basis in your traditional IRA. That means that's the non-deductible. Sorry, I'm trying to highlight this for you. That means that's the non-deductible part of your IRA. Now, that doesn't normally happen because you normally do not want to do it that way. But things can happen. By the way, there are other situations as well where non-deductible contributions can happen. We're not going to go into them because they don't matter. Just remember, if after you've taken the total amount that you put in during the year and then you remove any amount that you took a deduction for on your tax return, if there's any amount left over, that's a non-deductible contribution. And that's an important concept if you happen to have this happen. Okay, so are the contributions deductible? Yes. Now, to make a contribution to a traditional IRA and have it deductible, the next line, is taxable compensation required? The answer is yes. You have to have taxable compensation. If you have no taxable compensation, can you put money into a traditional IRA and take it as a deduction?
No.
No. Okay. Now, let's go to the next line, income phase-out limits. What are income phase-out limits? Well, it means that at a particular amount of income, it starts phasing you out so that you don't get to take dollar for dollar of your benefits. So phase-out limits happen over and over again in the tax law in different contexts, and the phase-out amounts change too. Now, that's a general statement. When we're talking about IRAs, we're talking about income phase-out limits. So when you have income, as your income gets higher, there's a point where they start decreasing the benefit, and then it phases out to nothing. So from this chart, are there any income phase-out limits for traditional IRAs?
No.
No, there are none. That means we don't have to worry about that. Okay, so there are no income phase-out limits. Okay, so you can keep doing this until you reach the other limits that are in place. What are some of the other limits? Well, let's talk about the age limit. The age limit for a traditional IRA is under 70 and a half years old. All right, so what's that telling us? That's saying that to do, excuse me, that to put money into a traditional IRA, you must be under 70 and a half years old. So if you're 71, can you put money into a traditional IRA? Okay, age 70, can you put money into a traditional IRA? Yes, that's right. 70 and a half is the key. That half year is a little weird, but just memorize that is an important number. You have to be under age 70 and a half. So that's an age limit. You have to be under age 70 and a half. There's also a couple of contribution limits. Now, what are the contribution limits? Yeah, it's either lesser of one of these, $5,500 or $6,500 if you're age 50, over age 50. Okay, so $5,500 or $6,500 if 50 or over. Okay, $5,500 or $6,500. This is an important piece of information to memorize. This is likely something that very well could show up on a test. Okay, so you cannot go more than $5,500, or if you're age 50 over, $6,500, or the amount of your taxable pay. So whichever is less. Now, does that make sense? Now think about this. I want to tie in this limit with this up here that says taxable compensation required. Yes, you got to have taxable compensation. And you're limited to the amount of your taxable pay that you earned during the year. That makes sense that it's this way, doesn't it?
Yes.
So all you got to do is look at this. Look at $5,500 or 6,500, 50 or over, 5,500 or taxable pay, and whichever is less. That's the maximum amount that you can contribute during the year to a traditional IRA. Okay?
Yes.
So,
When you say taxable pay, is
yes.
that like taxable wages and income, or does that
Yes.
include passive income as well?
Well, let me turn the question on you, because it's a great question. Is passive income taxable?
Yes.
Yes.
Yes. So that would be taxable pay.
Okay.
So it certainly does. What we're talking about is you do not include non-taxable pay. You would not include, income that for one reason or another fits in that column. Remember, the federal income or not, if it fits in the column of not taxable, do not include on your Form 1040, then it's not taxable pay, and you don't include it here. So it's just the taxable amount of your pay. Okay?
Yeah.
Okay. So, and remember again, you limit it to your taxable pay or $5,500 or an additional $1,000. In other words, up to $6,500 if you're 50 over. Okay. And this limit is the one I was talking about when I was using the example up here of this exception. Non-deductible contributions. The exception for non-deductible contributions, one example is how can you end up with a non-deductible contribution? You contributed more than that amount, and you didn't get it back out in the same year. So you just leave it there, but you just don't get a tax break on it. Okay? So contribution time frame, what do I mean there? I'm talking about the period of time in which you can make a contribution and have it potentially tax deductible. So what time can you do that? Well, it starts January 1st of the tax year that you're actually doing. And then it goes through April 15th of the following year. So let's use an example. Let's say that we're working on 2018 tax returns. And yet, obviously, you don't do 2018 tax returns until 2019 or later. So this means that for 2018, it started January 1st, 2018, and ends April 15th of 2019. So anytime in that time frame, you can put money into a traditional IRA and have it count for 2018. Now, that's pretty significant there. Why is this April 15th? What do you think that is?
And the filing of tax return.
Yep.
Yeah, that's why the date is there. But why do they let you make contributions in 2019 for 2018?
To help bring down your income levels to bring your tax down for the year.
No, that's exactly right. It's basically saying when you go to do your 2018 return, you start looking at it, realize I owe it a lot of tax. Man, I'd rather just put some money, slam away, $5,500 into my traditional IRA and bring down my tax for 2018. So as long as you do it before April, before you file the return in 2019, you're going to be able to take the credit for 2018. That's exactly what it's for.
I know the question I wanted to ask.
Okay.
It may sound stupid, but if I wanted to have more than one traditional IRA, can I do that and put the maximum 5,500 or 6,500 in each one? Or
no, it's across the board. It's not. Yeah, you're asking, hey, could I have more than one and apply the limit to each one individually? No, it's an aggregate limit. It gets added together across all your traditional IRAs.
Okay, that's what I thought.
No, that's a great question, and that's not a dumb question at all. That was a fantastic question.
Okay.
So let's talk about distributions. Now, distribution means when you take money out of it. Are distributions taxable? The answer is yes. Okay, the answer is yes. Why are they taxable? Because you took a tax break up here. Remember, You got to take a deduction for $5,500 up here. So when
Yeah,
you get that
pre-tax.
50, yeah, that's right, pre-tax. Well, yeah, it really pre-tax, it is the same concept as pre-tax. Truthfully, pre-tax and post-tax have to do with when you're working for someone, an employer, and they're taking things out for you. For the most part, most of the time, but not always, IRAs most of the time are done by you personally. So you've already been taxed on your income, but you turn around and get a tax break on it up here because you took a deduction. But the point is, though, is you got a tax break for $5,500 up here. So guess what? When you turn around and take that $5,500 out, they want to tax it because they gave you a tax break earlier. So just like you were mentioning, Noemi, this is the same concept as pre-tax, post-tax. Same idea. You're getting the benefit now. When you take the deduction up here, you're getting the benefit now, but when you get that money back, you have to it gets taxed later. So this helps you now, but you pay for it later. Okay?
But the theory is, isn't it, that if you're, once you retire, generally your tax rate is probably going to be lower than it was when you were working full time?
Yeah, that's the theory. The idea is you may be making, say, $70,000 a year while you're working, but when you go to retire and you start taking these, well, maybe you're only taking $30,000 a year of this. And so you're still going to get taxed on it, but you'll probably be at a lower tax bracket. That's exactly right. In theory, you might not. You still get taxed on it, though. And when do you get taxed on it? You get taxed on it in the year that you receive it. So if I receive it in if I retired and I receive it in 2018, I put it on my 2018 return. So common sense, if I receive anything I might receive in 2019, I put on my
2020 return.
But if I receive it in 2019,
tax return you file in 2024, 2019.
Okay, yeah, but you put it in your 2019 tax return.
Okay, yeah.
Yeah, you're right. You would file it in 2020, but you 2019. Just to help clarify, the terminology we use in the industry is the tax year means the year that you're actually working on. 2019 tax year, for example, we're in 2019 tax year. When we do this return, we're going to do it in the filing year of
2020.
That's right. So filing year means the year you're actually filing it. The tax year means the year that you're actually working on. Okay? So yes, distribution is taxable in the year that it was received. Now, are there exceptions to taxable distributions? In the tax law, there's almost always exceptions to every rule, okay? So we know it's generally taxable, but here are some exceptions. When you do a trustee to a trustee transfer, okay? Well, we know what the word transfer means. It just means you move it from one place to another. A trustee to a trustee transfer is actually when you're moving an IRA from one, okay, well, what is a trustee of an IRA? A trustee of an IRA is simply the person or company that holds it for you. Let me think of an example. Let's say you have a trustee. Excuse me. Let's say you have a traditional IRA with Bank of America. You've set up one through them. Well, you might have an individual trustee or a person that is overseeing it for your local bank. That's your trustee. Well, what if you wanted to move it over to say U.S. Bank? Well, you could do a trustee to a trustee transfer. They could move from one trustee to another. That's all it is. That's not going to be taxable because you're not really getting the money. That's why it's an exception to a taxable distribution. It is a distribution, but for one reason, investment reason or another, you actually just moved it over to another account. You didn't really withdraw it. Now, rollover. Rollover is different. This means that you actually got the money in your hand. and I don't mean cash necessarily, it's a check usually, but you got the money in your hand. And then you turned around and put that money into another traditional IRA. Okay. So if you do that for it to be a rollover, you have to move them and make it non-taxable. You have to do it within 60 days. Have to do it within 60 days. Okay. From the date that you get possession of that money. Let me give you an example that's just slightly different. Let's say you have a 401k. Now 401k really is part of this column over here. But let's say, because this is where you'll often see this happen. Let's say that you've got a 401k. I actually had this happen. I had a 401k. I left the company. They closed out the account. And they sent me the money. Okay, so here I've got the money in my hand. If I want that to be non-taxable, I can do it. I can do it by taking that money, and I went over and put it into my traditional IRA. I actually gave it to the trustee of my traditional IRA and said, here, deposit this. Now, I rolled that over because I did it about 30 days out. I did that. It got into my other account, and I could prove it. Therefore, it was a rollover. Therefore, I'm not going to be taxed on that rollover. I'm pausing because there's something I'm thinking about telling you, and I don't want to confuse everyone. If they withhold taxes, like they did in my case, if they withheld taxes when they sent me that money, let's say I'm going to make up the numbers here. This wasn't the real numbers, but let's say there's $1,000 I had in this account, and they sent me $900 because they withheld $100 taxes. Okay. And I go and put that check into a traditional IRA within 60 days. How much can I exempt from the distribution? In other words, how much will I not be taxed on? $900 or $1,000?
1,000.
1,000.
And it's actually 900. Let me tell you why, though. Because they took out $100 taxes, and all I did is put $900 back into a traditional IRA. See that?
Well, because you rolled that over within 60 days, aren't you entitled to get that $100 back?
No, you don't get it back because it's already sent off to the IRS by, say, the former employer or something. Okay. This is what you have to do. You have to make up the difference. For me to, in this example, if I had that situation, for me to make this up, that extra $100, I'm going to have to put some money out of my own pocket and put it in there. So I have to add it to the 900. Now I'm putting $1,000 into it. See?
So you mean it is not exempted to taxable distribution?
The 900, okay, $1,000 was sent to me because from a 401k. Excuse me, $1,000 is what I had from a 401k, but they only sent me 900 because they took out taxes before they sent it to me, and they sent that off to the IRS. So I only got 900 of the 1,000. If I take that 900 and put it into a traditional IRA in less than 60 days, that is going to be exempted. But there's still $100 that isn't because I didn't put that in. The only way to make that up is to add $100 out of my own pocket.
You have to remember, guys, the $100 is still in play. It's still a viable amount of cash. What happens is, because it was paid to the IRS, it's still going to show up as money that at the end of the year you can get back as a refund. So,
okay.
Right.
So it's still
very
money
good.
that's out there still.
Well put, Ryan. That's a great way to describe it. But here's the reason why you can add $100 to it out of your own pocket. Keep in mind, doing it this way, there's $100 that you have to show as taxable. In that example, there's $100 you have to show as taxable. But if you add another $100 to it, you're wiping that out and you're getting the benefit, because by putting it in now, it's on one hand, it's showing taxable income. There's nothing you're going to be able to do about it. But by throwing another $100 in there, you can take it back out again. And so you're simply going to have, truthfully, you're going to get your $100 back when you get your tax return, just like Ryan said. So by putting it in now, you'll get it back as part of your refund. Does that make sense?
Yes.
That was a great way to describe it, Ryan. Thank you. Go ahead.
But I have a question.
Yeah.
If you did not add 100, what will happen?
If you did not, what? I'm sorry.
You did not add 100. You only
did the 900.
So it is not a rollover.
No, it is. The 900 of that 1,000 is a rollover. The other $100 I'd have to pay taxes on.
Ah, okay.
That's all. That's all.
You still be subject to tax. Okay.
Yeah. It doesn't have to be 100%. You can roll over part of this and keep part of it, but the part that rolls over is exempt as an exception to a taxable distribution, but the rest of it is a distribution.
It would be the same thing as like you withdrew $100 from the IRA and you now have $100 available to you. You've given it to the IRS to hold on to at the end of the year.
Yeah.
You may get it back if you've paid enough in taxes as a refund, or it may just cover taxes you owe for something else. But
right.
That is still, it's like you've done a withdrawal of $100.
Yeah.
Even though it went to the IRS, that's the part that's messing me up, is that I didn't actually get the $100.
Consider the IRS as temporarily a bank. They're going to hold on to it, and you don't get to touch it for that till the end of the year. But then it becomes, it's your money then. Does it go towards taxes you owe, or do you get it back as a refund?
Yeah, you just get it as a credit along with any other taxes that were withheld from your checks or anything. It's still a credit. And if you overpay at the end of the year, because let's say you did add in another $100 and the total amount of the rollover is free and clear, you still had to put $100 out of your pocket. It'll come back into your pocket with the credit from the IRS because that's where the money went.
Yeah, I understand that part. It's just when you say that if the employer sent $100 to the IRS, and I only put the 900 in my account, and didn't add the 100 to it, I still owe tax on the $100 that the IRS has that I never got.
Yeah,
it's
that's not fair, is it? That's why I think why you're having trouble with it.
I'm like, it doesn't make sense.
Can I tell you what I really did in this situation? This is why I kept saying this is not how I handle it. You know what I really did in this situation? I took it back to my former employer and said, I knew the rules a little bit. They are supposed to give me some options, including a trustee-to-trustee transfer. What I did is I went back to them and said, guys, you never told me you were going to do this. You didn't tell me anything. You just sent me a check and took out taxes. So here's your check back. You haven't sent the money to the IRS yet. Reimburse it. Get me back to my example, $1,000. And I'll give you my IRA trustee's information and do a trustee-to-trustee transfer.
Yeah.
Now all $1,000 was sent directly from my ex-boss to the trustee of my IRA. That's really the better way to do it.
Yeah.
Anyway, I just brought that to your attention because I could see potentially them saying, okay, an example like that, $1,000, in an account, you got a check for $900, $100 taken out in taxes. You got a check for $900 and rolled over the $900. How much tax do you owe on this, or how much are you, and it would be on the $100. So that's
make sure you do it within
60
Make sure
days.
you do it within the time allowed.
Right.
The 60 days, because then the tax amount that you owe on it becomes zero.
Of that 900 in that example, it depends.
Of that
on how
900,
much.
right?
Yeah, but just remember. Distributions, this is what always keep in mind, distributions are going to be taxable to you. For traditional IRA, they're going to be taxable to you unless you meet an exception. And anytime you meet an exception, you can meet it partly. If you got this rollover, let's say you did get a full $1,000 check, but you wanted to keep 400 of it, you can roll over 600 of it and keep 400. In that case, how much of that are you going to be taxed on?
The 400.
400.
That's right. And how much of it is going to be exempt from distribution?
600.
There you go. That's exactly right.
How do the IRS notified regarding the rollover?
They actually get a form, similar to a W-2 form. You're going to get a 1099-R form. In fact, it's the same form that we've mentioned before on retirement when we've briefly touched on this a couple of times. It's a form that shows you your retirement amount and the amount that you got from retirement. It's called a Form 1099-R. And if it's
pensions, distributions, all those are, yeah.
Right. No, that's how it gets reported to them. So if say an employer, again, we're really talking more over here in this column, but if an employer sends you some money, sends you a check like that, say closing out a 401k account, they've got to also send you at the end of the year a Form 1099-R, and it's going to show how much it gave to you and how much it took out in taxes. So the IRS will know how much credit to give you for taxes. By the way, it will also show if it's a direct trustee to trustee transfer. Don't memorize this, but it'll have in the box 7, if I remember right, the box 7, it'll have code G in there. And G means
Right.
the direct rollover. They call it also a direct rollover here.
The code.
Yeah, the code G means direct rollover.
They will know that you roll over.
No, they'll know it only if you did it a direct rollover. In other words, a trustee to trustee transfer. If you do this kind of rollover, no, they won't. You're going to report this as income, and then you're going to have to do a special little form that's going to show the IRS that you rolled it over and how much of it you rolled over. That's all.
And here's the important part of that. If you're under 59 and a half, there's also a penalty that you have to account for. So
yeah,
you
we
have
haven't.
to make
Yeah,
sure
we're coming
that
to
that's
that.
in there.
Don't confuse them. You're right, Ryan. But I just want to make sure because we haven't touched
Right.
it.
But the rollover is not in 1099-R.
A true rollover that you do where you get the money and do it yourself, it's not in the 1099-R. It's going to show the distribution amount as if you kept it. You're going to have to report it on your tax return to the IRS that you rolled it over.
Yeah,
then
that's
you're
why.
responsible. It depends on where the check goes. If the check goes directly to another qualified account,
That's
another IRA or trustee account, then it should be reported on a 1099-R.
Right.
Otherwise, remember, the check is going to come to you, and you're then responsible to put it into the other account. So at that point, remember, they don't know that you deposited it. The check has come to you. Your former employer is now trusting that you will, or has the faith that you are doing something with it. So basically, they're handing you a check. You're now responsible for putting it into that, holding on to it, whatever you're going to do with it, and reporting that. So now it falls upon you to report it, and that's on your actual tax return where you report what you did with it, basically.
Did that make sense, Noemi?
Yeah, that's why we've been asking the client, did you roll over?
That's right. No, that's exactly right.
Exactly.
So in the end,
I'm looking for a form.
no, you're right. No, in the end, here's the trick. Here's just keep it real basic. A direct rollover, also called a trustee to trustee transfer, that gets reported on the 1099-R.
Okay.
That you'll know it from the code. In which case you put it in the tax return, but none of it's going to be taxable. Because remember, on the Form 1040, look at your Form 1040 for a second, page 2, line 4A. Let's say we had $1,000 direct rollover, or in other words, a trustee to trustee transfer. Line 4A is for the non-taxable amount. Line 4B is for the taxable amount. So let's say we got a trustee to trustee transfer. you're going to get a Form 1099-R, and it's going to have the code G as in golf on it. What are you going to put on line 4A if it's $1,000 that was transferred? What are you going to put on line 1,000? What are you going to put on line 4B?
If you direct roll over all?
Yes, all of
Yeah,
it. Well,
1,000.
but here's the thing, though. You don't have a choice.
No.
Hold on a second. You don't have a choice, though. A trustee-to-trustee transfer is of the whole amount. Remember that? $1,000 in account 1, and
okay.
move directly to $1,000 in account 2. It's all got moved over.
So zero, the taxable amount is zero.
Right. So if you get a Form 1099-R code G in it, that's a direct rollover or a trustee-trustee transfer. If you got that, all $1,000 goes into line 4A as non-taxable and 0 into line 4B because there is none of it taxable. Does that make sense?
Yes.
Okay. That's all you'd have to do if you have that kind. Now let's talk about the rollover of 60 days. Now let's pretend you had $1,000 and all $1,000 was sent to you in the form of a check. They did not withhold any taxes. You're going to get a 1099-R, but it's not going to have code G in it. The IRS is not going to know, and neither was your employer, whoever sent it to you. They don't know if you rolled it over or not. They have no idea. So they reported it to the IRS as a distribution to you, and thus you got a check. But you took that check of all $1,000, and you, within 60 days, put it into a traditional IRA. To report that, it's very similar, but you have to do a little form, a little calculation worksheet that you can show the IRS. And then on line 4A, you still put $1,000 as non-taxable. And on 4B, 0. You just have to, in between, you're reporting it the same to the IRS, but you're having to do a little, basically what you're doing is you're reporting yourself to the IRS. It was not taxable. Here, your employer or whoever sends you the form reports it because they know. Down here, they don't know. You have to report it. But that's how you report it. You just put the taxable amount on 4A and the non-taxable amount on 4B. And if the IRS wants you to prove it, they'll write you a letter, and then you have to prove that you actually rolled it over in the right time frame. Does that help?
Yes.
Okay. All right, so let's talk about the next one, when it can be an exception to a taxable distribution. That's when a transfer is ordered by divorce court. Now, look, this is pretty straightforward. Husband and wife, they get divorced. Husband's required to hand over perhaps one of his traditional IRAs to his wife. He has to have it transferred over. Look, this is pretty much the same thing as a trustee-to-trustee transfer, because usually it's going to be transferred from his trustee to her trustee. But technically, it wouldn't have to be. Both of them could use the same trustee, and it just be transferred from his name to her name. In either case, it's the same thing as a trustee-to-trustee transfer. It's not going to be it's not going to be taxed to you. Who is going to pay taxes on it when they get the money?
Who received it?
Wife. Let's say the wife received it.
Yeah, the wife.
That's right. The wife would pay the taxes on it when she starts drawing it out. There's one more exception I want to mention. When you have basis because of a non-deductible contribution. Remember, we started out this section talking about what if I put in $6,000 but could only subtract $500? How much basis do I have? How much basis do I have?
500.
That's right, 500. Therefore, I can deduct only the $5,500, but I have $500 that I couldn't deduct. That becomes my basis. Guess what? Anytime you get basis back from anything, you're not going to get taxed on that. So when I get a distribution from there, that $500 basis I have on it, I'm going to get that $500 back without paying taxes because I already paid taxes on it. I did not get a tax break on that. Does that kind of make sense?
Yes.
Garrett, are you still with us? Haven't heard from you in a while.
Yeah, I'm still with you. Makes
Cool.
sense.
Okay, cool. Let's go on to the next piece here. Required minimum distribution. Each year, annually, you have to do a required minimum distribution. They call it RMD for short so if you hear somebody talk about RMD, they're talking about a required minimum distribution. When do you have to start taking a required minimum distribution? You have to start taking it at age 70 and a half. Okay. Once you get to that date, you have to start taking required minimum distribution. So you must start no later than April 1st of that year. Excuse me, start no later than April 1st of the year after reaching this age. So if you turn 70 and a half in 2019, when do you have to take your first distribution? What's the latest date you can take your first distribution?
April 1, 2020.
That's right. So if it started in, let's say, going backwards, let's say your client turned age 70 and a half on November 1st of 2018. When did he have to take his first distribution by?
April 1st, 2019.
That's exactly right. And then every year after that by December 31st. So let's use an example. Let's say that you have a client that turned 70 and a half on December 15th of 2018. So December 15th of 2018, he turned 70 and a half. He has to take his he can get his distribution the next day. He can get it on December 31st. He can get it on January 1st. What's the absolute latest he can take his first distribution?
April 1st, 2019.
That's exactly right. So he should have had it by April 1st, 2019. When must he take his next distribution by?
December 31st of 2020.
Nope. Well, yes, December 31st of 2019. Every year.
Okay.
No, it's okay. I stopped on this because this is a question that you may actually see on an exam. It's possible. What they're trying to test you on is, do you realize that when on the first time that you get a distribution, you might have two distributions in a year? It's possible because you got your first distribution that's due by April 1st, and then every year you've got to have another distribution by December 31st. That's what they're trying to get at.
Yeah, so essentially if your birthday falls after April 1st, you can push that off until the following year, but then you'll end up with two distributions that year.
Right. The real reason they have this rule is for people like the example I was giving where, look, when somebody retires, or I should say retires, when they get to this age, it's not uncommon for some places to take 3-4 months to get that distribution going. You know, and so it's not uncommon if this person age 70 and a half that it takes the company that's got it 3 or 4 months to process the paperwork. Crazy, I know, but there it is. So that's why they're doing it. So what if somebody turns 70 and a half in December? Well, they're probably not going to get it done in time for December 31st. So they do give them till April 1st. Okay. That's why they're doing it. But in the year that they first start getting it, they may get a second distribution because of this rule, just depending on how it times out. Just remember, too, RMDs do not have to, they do not, that's the amount that has to be distributed throughout the year. As long as it gets, even if it gets distributed a little bit every month, as long as all of it, the full amount is distributed by December 31st of every year, the RMD is met. So maybe your RMD is, say, $10,000, let's say $12,000, make it easy. And you're well past 70 and a half. So you've been doing it for a while. They can do an RMD like $1,000 a month, as long as by December 31st of that year, all $12,000 has been released to you. So that's the key. Okay?
Okay.
All right, now let's talk about the penalty for early withdrawal. This is what Ryan brought up, and I didn't want to get ahead of us, just not so much for the guys here, but there are some others that are that may be watching this that are new to it. There is a penalty for early withdrawal. You cannot withdraw your money before you reach age 59 and a half. If you put money into a traditional IRA, you could not withdraw it before you reach age 59 and a half. Why is that? Why do you think they have that law, that rule? Well, let's ask this question. Forget that question for a second. Why do you think they have these benefits for these retirement plans? Why do you think the IRS gives you benefits and the Congress gives you benefits for saving for retirement?
Because they want you to support yourself and not rely on.
There you go. They want you to, yeah, exactly. They don't want you to rely completely on the government for your support. They want to encourage you to save. Part of encouraging you to save is make sure you don't spend it when you're in your 30s and 40s. They want you to save it. So they set a date of age 59 and a half is the lowest date that you have to get at least there before you can start retiring. And there's a penalty if you withdraw it before age 59 and a half. What is that penalty?
10%.
10% of the amount withdrawn. So
on top of the tax you have to pay on it already. So
that's beautiful, because up here, that's exactly right, because coming back up here, are distributions taxable? Yes, that's regular tax that you pay on that distribution if you withdraw it early, but you're also going to pay an additional 10% penalty. So let's say I'm in the 15% bracket. Okay, so let's do this. Let's say I'm in the regular 15% bracket. Let's say I withdraw $1,000 and I'm 40 years old. So first of all, if I withdraw $1,000, I'm 40 years old and I withdraw $1,000, what is my penalty going to be?
your penalty is going to be $100.
That's right. 10% of 1,000 is 100. So there's $100 extra I'm paying on that $1,000 just because I'm withdrawing it before I reach age 70 and a half. Okay? Excuse me, 70 and a half, 59 and a half. And then on top of it, if I'm in the 10% bracket, 15% bracket, regular taxes, 15% bracket, I'm going to be taxed 15% on that $1,000. So how much am I paying for just my regular taxes on that $1,000?
$15,000.
150.
On $1,000? On $1,000, what is 15%?
$1,000.
On $1,000. What is 15% of $1,000?
$150.
There we go. So I'm paying regular taxes of $150 on that, plus I'm paying an early distribution penalty of $100. So I'm paying $250 to get that $1,000 early. That's really expensive. That's why you don't want to get hit with an early distribution penalty if you can avoid it. Okay. What form is this reported on? It's reported, a distribution from a traditional IRA is reported on Form 1099-R. And it gets reported where? On the Form 1040 line 4. 4A and or 4B, depending on how much is taxable. Now, are loans available? You cannot get a loan against this, and I know that's weird, but there's one where you can't. There's a situation where you can. Just know that loans are not available for this. So we have been talking about a traditional IRA. Okay, any questions about traditional IRA before we talk about a Roth IRA? Okay. All right, so let's discuss a Roth IRA. How does this differ? A traditional IRA, and here's the big one, are contributions deductible with a traditional IRA? Yes, but they're not deductible with a Roth IRA. Now, why do you think they would do that? Because it's okay, because we haven't covered it yet. It's because a Roth IRA is a special type of IRA that allows you to go ahead and pay the taxes now on it and get the benefits later. So, just as Noemi pointed out earlier when we were talking about traditional IRA, it's sort of like pre-tax and post-tax that we talked about. Traditional IRA is similar to pre-tax in the sense that you get the tax benefit now, but you have to pay taxes on it later. Roth IRA is exactly opposite. You pay the taxes now on it, now, but you get a tax break later when you get it back out. And we'll talk about that. So,
post-tax.
It's similar to post-tax. It's not really the same thing, but it's the same concept. Okay.
Okay.
The reason it's not technically the same thing is because pre and post-tax has to do with payroll from an employer.
Okay.
But it's the same concept. It's when are you paying taxes and getting tax breaks. Look, if you're getting a tax break on your tax return, that's similar to a pre-tax situation. You've already paid taxes, but the IRS lets you get a tax break to take it back out. Well, that's similar to pre-tax. You get the benefit now, you pay later. Post-tax is exactly opposite of that. And traditional IRA is similar to pre-tax. You get the break now, but you pay later. Roth IRA is the opposite. It's similar to post-tax. You pay now, but you get the break later. Okay? So now we're going to go through just Roth IRA with each of these things. Are the contributions deductible? No. If they were deductible, you would have a traditional IRA, not a Roth IRA. Make sense?
Yes.
Do you have to have taxable compensation? Yes, you do.
Yes.
If you have no taxable compensation, in other words, no taxable income, you cannot contribute to a Roth IRA. Are there phase-out limits? Yes, there are. Income phase-out limits. So I do notice I did not put what the phase-out limits are, the amounts. I don't want you to memorize that. I don't think you're going to get tested on a phase-out limit. What I do want you to know is if you have income that meets a certain amount of money, they're going to start decreasing the amount that you can put into a Roth IRA. And if it increases enough, eventually it phases out, so there's nothing left, okay? For you, so for that particular year, you can't put money in. So it phases out. As your income increases, it phases out once you hit a certain mark. Don't worry about what the amount is. I doubt you're going to get tested on it, and it's just not worth putting the effort into. Just know this is the only one of these that has a phase-out limit applied to it. Because notice the one we haven't discussed is no. Traditional IRA is no. This is the only one that does have a phase-out limit. And it's just important to know that it exists. Okay? Now, what about age limits? Well, for traditional IRA, you had to be under age 70 and a half to contribute to it. But for a Roth IRA, there is no age limit. So, if you're age 70, can you contribute to a Roth IRA? If you're age 70, can you contribute to it? Yes. If you're age 71, can you contribute to a Roth IRA?
Yes.
If you're age 101, can you contribute to a Roth IRA?
As long as you have income.
As long as you're still breathing, right? And have income. You're right. No, you're exactly right. That's the point, is that one has no age limit. Now, this is unique also to Roth IRA. This is the only one that does not have an age limit. The other two do. Okay? Now, let's talk about contribution limits. So what is the maximum amount each year that you can contribute? Well, this makes it easy. The maximum amount for a Roth IRA is the same amount for a traditional IRA. And what is that? It's limited to your taxable pay or $5,500 or 6,500 to 50 or older, whichever is less. So taxable pay or 5,500, whichever is less. It's the same as a traditional IRA. Both IRAs are the same for this. Contribution time frame, again, that's asking when can I put money in there? Same as a traditional IRA. You have to from January 1st of the tax year to April 15th of the following year. Okay. What distributions are distributions taxable? No. For Roth IRA, where they were for traditional IRA, they were taxable. Well, again, I want to stress, in a traditional IRA, you got a tax break up here. You got to deduct something, so it became taxable down here in the distributions taxable column. But on a Roth IRA, did you take any deductible contributions?
Nope.
No.
No, you can't. You're not allowed to. And as a result, your distributions are not going to be taxable. Now, so far that's pretty straightforward. Now, the reason I have this segment in here that says must meet requirements, and that is because you have to have actually held that for a period of time. Once you establish it, you have to have money in there and hold it for a period of time before it's actually going to be considered not taxable. If you remove it before that period of time, you're going to have a problem. Okay. That's all I really wanted to get into there, just to mention to you, you have to meet some minimum requirements when you first get it going. Basically 5 years, just to let you know. You basically have to have it for 5 years. Once you hit that 5-year mark, then it's not going to be taxable to you. And why do you think they're doing that? They don't want people to put money into a Roth IRA and turn around and take it out 2 years later, when really they're just doing it as a way to avoid taxes. That's why they're making you meet that requirement. Okay? All right. So what about exceptions to taxable distributions? Well, I have this under exceptions, even though the taxable distributions usually are not taxable. But the reason I have it, I say same as traditional IRAs, is because I want to point out that you can do a Roth IRA, trustee to trustee transfer, Roth IRA rollover, Roth IRA transfer ordered by a court. You can do all those. You can also do something called a conversion. A conversion is a unique thing for IRAs. This is when there's the movement of funds from a traditional IRA to a Roth IRA. Okay, so movement of funds from a traditional IRA to a Roth IRA is called a conversion. Now, let's say I have $1,000 in a traditional IRA. If I take money out of there, if I get a distribution, is that taxable to me?
Yes.
Yes.
Yes, it is. So if I want to do a conversion, am I going to have to pay taxes on that $1,000 I withdraw?
Yes.
Yes. That's why it says here, taxable to the traditional IRA. Why would you maybe want to do this, though? Well, you might want to go ahead and pay the taxes on a traditional IRA and convert it to a Roth IRA and let it sit there for several years to build up lots and lots of money so you don't get taxed later. This is a way to save money in a situation where maybe you have a client that got laid off and only has a little bit of unemployment. His tax bracket is going to be way low. It might benefit him to withdraw his $10,000 out of his traditional IRA, pay the taxes on it, because it's not going to bump up his income very much. It's not going to bump him into another tax bracket. And so now he pays some taxes now, and now he's setting himself up for a big amount in his Roth IRA down the road. So you can see how a conversion might help somebody if you plan it right. Any questions about that before I go on to the next page here? Okay, guess not. Not hearing anything. And RMD, what does RMD stand for?
Required minimum distribution. Perfect.
The required minimum distribution. Is there one for a Roth IRA? No.
None.
Technically, it is. There is one, but it's not until death. And that's because they won't let a Roth IRA continue past the individual's death. At that point, it has to be cashed out and given to the beneficiary, and the beneficiary is either going to be the estate, a trust, or an individual. An estate is just the group of, when somebody passes away, an estate is created just to handle all their belongings until they can give it away or sell it or whatever they're going to do with it. A trust is something created by decision to create a trust, and that can kick in at somebody's death if it's in their will, or of course the beneficiary of a Roth IRA can be an individual. It could be your wife, it could be your daughter, it can be whoever. So there's really no RMD by normal way we think of it until the person passes away. Okay, penalty for early withdrawal. There is none. Why? Because it's all tax-free anyway. The only exception, remember up here I said you must meet certain requirements. Here's the requirements you have to meet. If you held it for at least 5 years and withdraw it after age 59 and a half. Okay, so there's no penalty. All you have to do is reach age 59 and a half, just like traditional IRA, so that part's the same, and you had to have held it for at least 5 years. Okay, so those are the two things that are required. As long as you meet those basic requirements, you're not going to be taxed on any of this. So you're not going to get taxed on your basis that you put in it, and your basis is the money you actually put in there. You're also not going to get taxed on the interest and other wealth it's grown. Over 20, 30 years, this has grown from maybe 40,000 you put in there to 100,000 because of interest and everything. So if it's grown, you're not going to get taxed on any of it as long as you meet these requirements. You're not going to get taxed on any of it. That's a huge benefit. It just means that you don't get a tax break early on, but you get it all later. Can you see why that might be beneficial to someone?
Yes.
Yeah. Yeah. What form is it reported on? It's reported on a Form 1099-R, just like a traditional IRA. So these are reported on the same form. How do you report that? You report it on, first of all, you have to do Form 8606. 8606 is a special calculation form. It's required when you have a Roth IRA so that you can keep track of how much money you have in that Roth IRA and what your basis is in it and all that. It's a reporting instrument to the IRS so that when you start taking it out, they don't think you're lying and you're really taking it out of a traditional IRA. They're thinking, because you could take it out and they wouldn't know if it's traditional or Roth from what they're saying. By doing the 8606 it's required, it's a way to keep track of that, and that way there's a paper trail with the IRS so you can prove this was a Roth IRA and you put this amount of money in each year over several years, and that's how you track it with them. Now, after you do the Form 8606, then you just report the amount on Form 1040 line 4, just like we already looked at. Okay. All right. So that is a Roth IRA. Before we get into the other questions, go ahead.
Yeah. You need to attach the Form 8606 to 1040.
Yes, you do. Yes. Yep. Good question. Yep. The Form 8606 has to be attached. It goes to the IRS. It's really a paper trail you're creating with them so that they can never and will not come back on you at some later date and say, oh, you should have paid taxes on that. That's why it's so important. Good, great question. Any other question there? Nope. Okay, let's go to our third column. This is kind of a catch-all column. It's called qualified employee plans. First of all, notice it says employee plans. We're talking about things like 401k, which is probably the most common, but you have other kinds. You have 403B, and if I'm not mistaken, 403B is the type that's used by teachers, you know, teacher unions and all that. But there are many different kinds, okay? And why, by the way, where do we get these numbers? 401k, 403b, those are section and subsection numbers in the tax law. That's all it is. If you went to the actual IRS code, the actual tax law, and open up the book and went to the right section, you'd eventually find the one section that's called 401k. 401 is a section that lists certain type of employee plans that qualify for special tax treatment. That's what qualified means, qualifies for special tax treatment. And then you'd have a paragraph called K that would mention the specific kind that we're talking about. You know, that is the most common. You have 403B. They're all doing, that's all the numbers mean though. So, and again, I got to stress, qualified means qualifies for special tax treatment. And they got to be employee plans. So if they are an employee plan that is a qualified employee plan, these rules apply to them. There are such things as non-qualified employee plans. We're not going to talk about those. I just want you to know that they exist. But if they're not a qualified employee plan, or what they call a non-qualified plan, these rules don't apply here. So a qualified employee plan, contributions deductible. Are their contributions deductible? Yes, they usually are. They usually are. How are they going to be deductible? Noemi? Remember, this is coming from an employer. So is this going to be pre-tax or post?
Pre-tax.
Pre-tax, that's exactly right. So you're going to get the benefit now. It's bringing down the amount of income that they're going to show for tax purposes. Now, there is an exception, and that's for non-deductible contributions. Again, there can be situations where maybe you contributed too much, and so now some of it's not going to be deductible. Well, that becomes basis to you, and that becomes basis, but you're not going to be able to deduct that amount. But at least now you got basis in it that you'll get back tax-free. Now notice, traditional IRA, contributions deductible for traditional IRA, yes, usually with the same exception as a qualified employee plan. Just want you to see the similarities here. So this is similar for contributions. This part's similar to the traditional IRA. Is taxable compensation required? Yes.
Yes.
So there's a pattern here. All of these require taxable compensation. They're not going to give you any benefit for saving for retirement if you haven't earned any money that year. Income phase-out limits. Are there any? No. So just like I mentioned before, notice that the only one that has income phase-out limits is Roth IRA. Traditional IRA and qualified employee plans do not have phase-out limits for income. Age limits. Under age 70 and a half. That's the same thing as a traditional IRA. Under 70 and a half. So that means they can continue to contribute from their, even if they're working even up to 70 and a half, they can keep contributing to, and I'm going to use a 401k as an example throughout this, just so we have one to talk about. But let's say somebody's working at Walmart part-time. As long as they're under age 70 and a half, they can keep contributing to a 401k. Contribution limits. Well, this is different than both of the IRAs. The traditional IRA and Roth IRA have their own contribution limits. Contribution limits for 401ks and other similar retirement plans is $18,000. You do want to memorize these amounts. $18,000, and then if you're 50 and older, $24,000 per year. $18,000, $24,000 for 50 and older. You do want to remember that. So that's the maximum amount that you can contribute. And you can keep contributing until you are how old?
70 and a half.
Perfect. Perfect. That's exactly right. All right. What is the contribution time frame in which you can do that? It's the same as traditional IRAs. So this makes it handy. These are all the same all the way across. January 1st of the tax year to April 15th of the following year. These are all the same. That's the same. They all have the same contribution time frame. Are the distributions taxable? Yes, they are taxable in the year received. Why? Because this was pre-tax. You took the tax benefit early on, but when you get the money distributed to you, you have to pay it. And you pay it in the year received. This is exactly what it was for a traditional IRA. All right, what about exceptions to taxable distributions? Well, the same thing as traditional IRAs. You can do a trustee-to-trustee transfer, or in other words, called a direct rollover, but trustee-to-trustee transfer is what the proper terminology is. You can do a 60-day rollover, or you can do a transfer ordered by a divorce court. Or you can have when you have basis because of the non-deductible contributions. So you can see how similar the 401k and employee compensation is to the traditional IRA in many of these things. Okay? But there's one other thing we want to talk about out here. It is similar, it is the same as traditional IRAs for exceptions to taxable distributions. But I want to make a statement here. If you have basis, usually use the simplified method to calculate how much is taxable. There's different ways you can calculate some of these things. One way is using a simplified method. The other way is using a standard method. Just this is not so much for testing as it is for practice. If you have basis in your say example 401k, in other words, maybe you contributed too much one year, or for one reason or another you weren't able to take all, you were not able to get a tax break for all of what you put in. If that happens, you have some basis. If you have basis, it's usually better to use a simplified method to determine how much is taxable. Don't worry about how to calculate it. Just kind of memorize the simplified method. Simplified method is kind of confusing. There is a form to help you do it. So if you do it, you just follow the form in real life. Okay? Because remember, this is true even for a traditional IRA anyway. Remember, we were using the examples, let's say you have a basis of $500 but got $2,000 during the year. Well, you have $500, but you don't necessarily take all $500 right up front. You kind of spread it out over the payments over years. And that's what these methods do, is they figure out how much you take of the basis each year. Does that make sense about the basis and kind of what's going on with the calculation?
Yep.
How do you feel about that, Noemi?
Oh, I have a note. I'm just back. I went to the restroom.
I was just saying that's okay. That's okay. I was just saying that simplified method, anytime you have basis in a traditional IRA or an employee, what am I trying to say, in a qualified employee plan, like a 401k, if you have basis, let's say you have $500 basis in it, but you actually took $2,000 out. In theory, you would only get taxed on $1,500. In reality, you don't necessarily take all $500 all in the first year. You spread it out over a period of time and take some each year. That's what the simplified method helps you do. But all I was saying is don't memorize anything more than, hey, it's better, usually it's better to use the simplified method if you have a basis in your 401k or other employee plan. It's usually better to use the simplified method. That's all.
Okay.
Okay. RMDs. RMDs for an employee plan are the same as a traditional IRA. Well, that makes it easy. 70.5. Okay. Penalty for early withdrawal. Same as a traditional IRA. 59.5. If taken out before 59.5, how much is the penalty?
10%.
10% of what amount?
You taken out.
Exactly right.
Withdraw, yeah.
Yep. What forms do you get these on? Well, both of the IRAs were forms 1099-R. This one can be on a 1099-R also, but there's also some other types of 1099-Rs that we're going to just briefly touch on. There's a CSA 1099-R. Anybody know what that is?
Civil service.
Yeah, that's
civil
right.
Servant, right?
That was the key. That right. CS stands for civil service. CSA stands for Civil Service Annuity. This is a regular retirement from civil service. For example, somebody worked for the federal government, and I don't mean military when I say that. I do not mean military. I'm just talking like, you know, they worked for NASA or something like that, whatever. Actually, my father worked for the federal government for a while as a teacher, and so he has a civil service annuity, and it's called a CSA 1099-R. There's also a CSF. Well, if CS stands for civil service, what do you think the CSF would be for? Not the F, but I mean, what do you think this is talking about? It's all right if you don't know. CSF is for somebody who's passed away. It's a survivor's annuity is what they call it for short. It's somebody's passed away, but it's often a spouse will get this. The husband passes away. The husband, while he was alive, was getting the CSA 1099-R. He passes away. Now his wife gets it as a CSF 1099-R. That's the difference. CSF is always survivors. That's the only type there is. There's also RRB-1099-R. What do you think RRB stands for?
Railroad
Benefits, yeah.
Railroad Retirement Board. Yeah. And these are not, we're talking about, and if it's a 1099-R, it means a pension, okay? Or annuity or whatever they call theirs. I think they call them a pension. My point is this is not their equivalent of Social Security. This is not their Social Security. We're talking about retirement, you know, and the railroad does its own thing completely. It kind of opts out of everything else federal and does, except for federal income taxes, it does its own Social Security. It does its own retirement, and that's what it is.
On two different forms, but they're both 1099-Rs. One's green and one's blue, though.
Yeah, you're right about the colors, but it's not. Their equivalent of Social Security is an RRB. You know what? I might have to double check that. I might be wrong. Might be wrong on that. They have their equivalent. I was going to say something, but I think I may be wrong on that. So you might very well be right. Here's the point: is that if you see RRB in front of it, you got to be very careful because there's Social Security, their Social Security equivalent, and there's their pension. And all I'm referring to here is their pension part. We haven't even really talked about Social Security. If you remind me, I will check on that, what I was thinking, and see if I'm right or wrong. I can find out. How do you report it? Once you know what's there and what it is, and it's like a 401k, how do you report it? Well, same thing as always, Form 1040, line 4. Notice all of these, you end up reporting them on line 4 of the Form 1040. It's the same thing over and over again. And are loans available? This is the only one where there's loans available. And so no IRA has loans available. And by the way, not all qualified employee plans have loans available either. But what do we mean by a loan available? A person who works for a company that does do loans and permits loans against their, say, 401k or whatever they have. What that means is they can go and actually draw a loan from the company. Now, a loan means what? That you have to sign documents saying you'll pay it back and you're going to get charged interest for that, right?
Yes.
Okay, so if you do a loan against this, what you're really doing is you're doing a loan from the investment money that's in there. But you've got to pay that back with interest by the agreement that you sign. And if you don't, what do you think they do?
They will get your investment.
Yeah, basically, you're right. They actually convert that into a early distribution. Okay, so let's say, for example, you got $20,000 in a 401k. Okay, don't worry about all the technicalities for those of you that know more about this, but just keep it simple. Let's just say we got a 401k, $20,000 invested, and you want to borrow $1,000. You don't want to do an early distribution, do you?
No.
No. Why don't you want to do an early distribution?
Penalties.
There's a penalty.
Sure. Plus, you'd pay regular taxes in addition to the penalty.
Yeah.
No, what you really need is a loan. A loan that you can maybe get from your employer for maybe, 5% a year that you intend to pay back in less than a year anyway. So the whole thing's only going to cost you a few dollars. So you want $1,000 loan. You go to your employer. He says, okay, we'll do this. You got to sign this and agree to pay us like 5% interest, whatever, per year, compounded monthly, let's say. Okay. So now you got $1,000 in your hand. You go use it however you want. There's a payment plan set up, say $200 a month that's taken out. That you're supposed to write them a check for. As long as you pay it back in the time allotted with the interest, nothing has affected your actual $20,000 sitting in there. But let's say you end up not making any of the payments. Well, guess what? They're going to take that $1,000 that you borrowed plus the amount of interest you were supposed to have paid. So let's say another $5 in interest, so $1,005. They're going to do an early distribution on you. They're going to send you that money, and you're going to have to pay 10% penalty on that $1,005 plus regular income tax on that $1,005 because they're going to convert that into a distribution. So this can actually be really beneficial. And why do you think some places allow this? Why do you think they would allow that?
Well, it's a benefit to their employee.
It is that. Well, these are not things that you'll find in your book. These are the things where if you just think through them, you can figure out why they may do that. What do you do with money? What does a company do or you do with money that you put into a 401k? Or is it just sitting there in the desk drawer of your employer?
Earning interest.
It's earning interest somewhere. It's invested somewhere.
Yeah.
What kinds of things could they invest in? They could invest in stocks and bonds or loans if they want. They see it as an investment to yourself. You're paying interest on your own money, but that's why they're willing to do it in some cases. Okay? This is the only one that allows loans. Do you see it? Yes. If you ever see money from a loan, and I've had this in real life happen, somebody comes in and you ask them, okay, did you receive any distributions from a retirement account? If they did, they should have gotten one of these forms. But sometimes people don't realize what the forms are or their significance, so they might have had a real distribution. But what if they got a loan? Sometimes, and I've had this happen in real life. Somebody says, well, yeah, I got $1,000. I took it out and I'm paying it back. Oh, they don't know the difference between a loan and a distribution from the retirement account. In that case, you just find out about the loan, make sure they're paying it back, and if they are and they're in good standing, then you got nothing to worry about here. So, all right, guys, that's a pretty high-level overview of these three things, but with this mixed with your reading, I think we'll get you through this. What do you think? Any questions, comments, clarifications?
James, it was a good explanation. You did awesome. That was really good.
Thank you. Thank you.
Awesome.
Thank you. I'll pat myself on the
Very
back.
well done. Yes.
Okay, guys, I appreciate that. I wasn't, that's nice of you to say that. I wasn't asking for the compliments. I appreciate it, but I just want to make sure it's making sense to you guys. I'm jumping over for a second to the federal income or not, just so we can take a quick look at that. If you printed that out, you might want to now, just so we can see this little federal income or not. Page 2, you see the retirement ones on the left. So Garrett and Noemi, would you let me know when you got that in front of you, just so we can do a quick review of this?
Got it.
Okay. And Noemi?
What, Social Security income?
Look on the federal income or not pages that I sent to you. Page 2 of it.
Okay.
Yeah. Do you have it there in front of you?
Yes, yes.
Okay, so look at the retirement. I just wanted to show you how this plugs into my little thing here. Retirement for IRA distributions, generally they're taxable and they're reported on a Form 1099-R.
Yes.
This is the taxable column, non-taxable column. Retirement IRA distributions, it's not taxable when there's a trustee-to-trustee transfer. When there's a rollover, if there's a rollover, it has to be rolled over in how many days?
60 days.
60 days. Or when there's a non-deductible contribution, because you've got basis in that. You get the basis back for free. Also, under retirement, we have Roth IRAs that are not taxable generally. And I say generally because there's always exceptions to everything, but you know what? You're just, the generally is here because remember, you got to meet 2 basic requirements to make it not taxable. What are those 2 requirements?
Hold for a period of time, 5 years.
That's right. And?
Not withdraw before 59.5.
That's right. And be under 59.5. Okay. Now let's go down to this retirement, other types that are not IRAs. These are like the 401ks and everything. Generally speaking, this is going to be taxable and they're reported on these different forms. Other types, when they're not, these other types are not taxable when there's an after-tax contribution basis. In other words, when you have basis that you get a pullback. Okay?
Yes.
That's basically it. So, the next thing we're going to talk about is Social Security. Let me tell you where we're going now. We've talked about retirement in the forms of pensions, annuities, 401ks, stuff like that. Now we want to talk about the type of retirement that comes from the government. And when we finish talking, and that's called Social Security. Now, when we finish talking about Social Security today, we're going to just start jumping into a list of other income that's on this list here that you can see up on the screen: alimony, child support, gambling, and so on. We're going to talk about that. These are just a bunch of little rules, nothing major. It's what the hardest part about this is just remembering which part goes on which side. But again, I want to just tell you where we're heading. So what we could do is, if you guys have printed out the Social Security page, have you?
Yes.
Let me ask you, we could take a lunch break now if you want to, or we could do this and then take a lunch break. This is one page, probably need about 15 minutes to go through it. It's up to you whether or not we take the break before this or after this.
Before. Garrett.
You want to take the break now? Is that what you're saying?
Yes.
Okay. All right.
Yeah, that works for me.
Okay, great. So we're going to take a break.
Yeah, I'll get some coffee.
Yeah. So let's say 15. Actually, let's do this. Let's say at 12. Let's just say 12:15. We'll all be back here at 12:15. That's close to 20 minutes from now. Okay.
Okay.
All right. And all right. Sounds good. Thank you. All right, everyone. We're back from our break. We talked about retirement plans. Now we're going to talk about Social Security income, and I kind of put them together because so it is really a type of retirement. It's just Social Security is done by the government. That's why you pay Social Security tax on your income. What's the percentage of Social Security tax you pay on your income?
6.4.
6.2.
Close. Yeah, it was 6.2%. It's okay. It's okay. You started and I started answering right. No, 6.2%.
Okay.
Now, trying to remember if this was in here or not. One thing I want to say, and we were talking about it, is if somebody works for the railroad, they have what's called railroad retirement income, and their railroad, they have the equivalent of Social Security. Even though it's reported differently, Social Security gets reported on an SSA-1099R. Okay. And anyway, it gets reported on an SSA 1099R. You know what? I think I'm going to do something here, guys. I think I'm going to actually bring this up, and we're going to look at one together just so you know what one looks like, because we were talking about it a moment ago. Okay. I'm actually doing the search right now. I am trying to get one to come up here. I thought I'd be able to get one right away. Yeah, see, I keep getting explanations about them and not the actual form. Well, my apology, guys. I thought it would actually give me the form. Silly me to think that the railroad would give me a copy of the actual form to look at. Yeah, it does not look like that. Okay, my apology, guys. I will try to get one and show it to you later. But this is what I want you to know. They have two things.
James, what is it you were trying to pull up? I'm sorry.
The Social Security, excuse me, the Railroad Board 1099Rs and I wanted to show them the actual, yeah, and their Social Security equivalent form. I know what it looks like, but I can't seem to locate it.
Okay, I'll see if I can pull it up.
Okay, that's fine.
So you keep talking. I'll just see if I'm able to.
Okay, no, that's fine. So here's the point, guys, is they have their equivalent of Social Security. They don't actually pay into Social Security like everyone else does. They have their equivalent of Social Security, though. It's treated the same. It's done the same. They just keep it separate from Social Security. They call it Railroad Tier 1. But don't worry about what all that means. Just know that they have their equivalent of Social Security, okay? But it's treated the same as here. When you're calculating it, pretend if you have a railroad person, just get the Social Security part separated from the other retirement part, the pension part, and calculate it the same way. So regarding Social Security income, again, we're talking about whether it's taxable or not, and if it's taxable, how much. So everyone should have the handout already available to them. I sent it out earlier today. So what's the first step in figuring this out? Well, step one starts with calculating total income. How do you do that? First of all, you start out with 1/2 Social Security income. So you take from, and we're, by the way, all the way through this, I'm going to talk as if it's Social Security and the Social Security statement. Okay. I'm not going to talk railroad, but it would work the same for the railroad Social Security equivalent. You take, first of all, you take off the form 1/2 of Social Security income. So whatever that amount is for Social Security income, take 50% or 1/2 of it. Then you add to that all other taxable income. Now in this here, notice I say taxable income, not tax exempt income, not stuff that's not supposed to be included. just the taxable income. So you add all other taxable income, and you also add in one thing only that's tax exempt, and that's tax exempt interest. Okay, that's found in Form 40, line 2A. You could see that for yourself, but you don't have to look at the form to figure this. 1/2 Social Security income plus all other income. That's the short way to really think about this. 1/2 Social Security income plus all other taxable income, which would include tax exempt interest, what would normally not be taxed. You add all that together and you get total income. It's that simple. Step one. So, what's an example of tax exempt interest?
Interest earned from a bond.
Well, what kind of bond? It depends on what kind of bond we're talking about.
U.S. savings bond.
bond.
A municipal bond. U.S. savings bond is going to be exempt from state tax, but not federal tax.
Okay.
Remember that?
Yeah, okay.
And then, but muni bonds, municipal bonds that we talked about, those are exempt from federal tax. They don't tax them. So that would be an example if there were some muni bonds that you were able to not put in your federal income, you'd have to add them in for this purpose. You'd add all your other taxable income, and then you'd add in half of your Social Security income, and you'd have total income. Now that becomes important because we keep using total income for a lot of this now. So in step two, you compare your total income to the base amounts. Now this is the chart that we're going to use for determining that, and I want to kind of walk you through it. Column 1 has your different filing statuses. Then column 2 has a base amount, and column 3 has the additional amount. Okay? So in column 1, I want you to notice we have MFJ, MFS, and all others. Okay? MFS, you'll notice everything is 0. Okay? If you can just remember, if you're MFS and you lived with your spouse, all your amounts, I'm sorry, that keeps clicking all over. If you can just remember, if you're MFS and you're living with your spouse during the year, your base amount and your additional amount are both 0. Then it gets a little simpler because all you got to remember are 4 amounts. MFJ, base amount is $32,000. Additional amount is $44,000. In other words, upper amount, base amount and upper amount. And then all other filing statuses, single, head of household, MFS, where you did not live with the spouse, is $25,000 for base amount, $34,000 for additional amount. Now, why do I want you to memorize this? Because one, it's simple, and a little bit of simple memorization and a couple of steps here will help you be able to quickly answer questions on a test. And it'll just help you. Do you really have to memorize this? No, because there are forms that you do this on in real life. But on a test, to be able to quickly get at what will probably be questions, if you have questions about this, chances are you're going to be able to quickly answer it if you know steps 1 through 4. Okay? So that's why. So what is the base amount for MFJ?
32,000.
What is the base amount for all others?
25,000.
Okay. What's the additional amount for MFJ?
44,000.
And for all others, additional amount?
34,000.
Right. What is the base amount and additional amount for MFS if you lived with your spouse?
0.
Okay, there you go. So step 2 just says compare your total income to base amounts. So we've calculated total income in step 1. Now we're going to compare that. If I'm MFJ, my base amount is $32,000. If I'm all others, any other filing status, I'm $25,000. Now, step 3, you take the result. If the total income is equal to or less than the base amount, it's not going to be taxable. So if I add up my total income, and my total income is $20,000, and I'm MFJ, is my Social Security taxable?
No.
No.
No, because what's my base amount that I'm comparing it to?
32,000.
Right. What if I'm single with the same amount of income? Is my Social Security taxable?
No.
Yes.
How much again?
20,000 is what I said.
No.
20,000. Oh, sorry.
Yeah,
Okay.
20. That's okay. 20,000 is not taxable because of that. No, that's exactly right. So, if I lived with my wife and I'm filing separately from her, is it taxable? My 20,000?
Yes.
Ah,
Oh,
yes.
no. Separate from her? No.
No, I said I lived with her. I'm filing separately from her. I'm filing MFS, lived with her.
Yes, it is taxable.
Absolutely, because they have no base amount. All of it's going to be taxable. Okay. So
why is that? Do you know?
because our tax code favors the married and with children. That's why. That's the real reason why. They over and over again you're seeing that pattern. MFS is disadvantageous in many circumstances. It's built into our tax code.
Okay.
What is the additional amount?
We'll talk about that. Well, I'm not there
Ah,
yet.
sorry.
Yeah, it's okay. It's okay. I just wanted to show you what's here. So if the total is equal to or less than the base amount, it's not taxable. So what if I'm single and have $25,000 of total income? I'm single. Is that going to be taxable?
No.
Not
No.
taxable. Yeah.
Because it's equal to the base amount. That's exactly right. But let's look at the next one here. If my total income is more than the base amount, we know it's going to be partly taxable. Okay. So if it's less than the base amount, equal to or less than the base amount, it's not taxable. You don't have to do anything more. If it's not taxable, it's not taxable. All you would do is let me find it, on line 5A, on the Form 1040, I'm looking at Form 1040, line 5A, you'd put the amount of Social Security benefits you received. Line 5B, you'd put 0 because line 5B is the taxable amount. Okay?
Yes.
Okay. So if we, though, are above the base amount, then it's going to be partly taxable. We've got some more work to do to determine how much of it's taxable. So that brings us to step 4. If it's partly taxable, you got to do another comparison. If that amount is between the base amount and additional amount. So in other words, before I go any further, if it's between, let's use MFJ as our example, if it's between 32,000 and 44,000. So let's say our amount is 35,000, it's between the two. If it's 41,000, it's between the two. So if it's between the base amount and the additional amount, up to 50% of your Social Security will be taxable. That doesn't mean you'll get taxed 50% of your Social Security. You'll get taxed on 50% of your Social Security. So if you have $20,000 of Social Security, you could potentially, and you fit in this category, you could potentially get taxed on how much of your Social Security?
10,000.
10,000.
Yeah, that's right. So that's how it is. But keep in mind, what happens is we determine how much of your Social Security is going to get taxed, and then we add it in on the Form 1040 on line 5B. It just gets added in. That amount gets added in with all of your other income that you have. Okay. So step 4, if partly taxable, you have to determine if it's between the base amount and additional amount or if it's above the additional amount. So what do we mean by above the additional amount? Well, if it's above 44,000, so for MFJ, so if I'm married and I have $45,000 of income, I'm above the additional amount. If I'm single and have $36,000 of income, I'm above the additional amount. So I got to figure out where I fit. Do I fit between the base amount and additional amount, or do I fit above the additional amount with my total income? If I'm between the base amount and additional amount, up to 50% is going to be taxable. Now, that's the maximum amount that's taxable if you're in that range between the base amount and the additional amount. How do you calculate that? This looks weird, but it's not so bad. We're just going to break it down. You take the lower of these. You take 50% of line 1 or 50% of line 2. So what's line 1? 50% of line 1 is total income minus the base amount. All we're saying is total income from step 1 minus the base amount from step 2, whichever one applies to you. So let's say my total income is let's say I'm single, $26,000 total income. Which base amount applies to me?
25,000.
And in step 3, is the total income equal to or less than the base amount?
No.
Is it more than the base amount?
Yes.
Yes.
So it's partly taxable. If it's partly taxable, is it between the base amount and the additional amount?
Yes.
Yes.
So potentially I'm looking at how much of my Social Security being taxable.
Up to half of it, 50%.
That's right. That's right. Now, technically, it's not going to be that, and you'll see why. Because now I take my total income minus my base amount. What's my total income in this example?
26,000.
Minus
25,000.
leaves me with,
$1,000.
okay, so 26,000 minus 25,000 is $1,000. What's 50% of $1,000?
500.
500.
$500. Okay, perfect. So we're saying the lower of $500 or half my Social Security income. If I had $10,000 Social Security income, what's half of that?
5,000.
That's right. So what's lower? 500 or 5,000?
500.
500. That's how I get it. That's the amount that I would put on there. So what number would I write on line 5B of the Form 1040?
500.
500. Okay, let's do another one. This time we're going to say MFJ, and we have $35,000 of income, total income. So let's go through the steps. We've already added total income. What's the base amount I use for MFJ?
32,000.
Okay, let's go to step 3 then. The result, if total income is equal to or less than the base amount, it's not taxable. Is it less than or equal to the base amount?
No.
No. If the total is more than the base amount, it's partly taxable. Is it more than the base amount?
Yes.
Yes. So step 4, partly taxable if it's between the base amount and the additional amount. Is it between those amounts?
Yes.
Yes. So let's do this together. Total income minus base amount. What's the total income?
35,000.
Minus the base amount of?
32,000.
Leaves us with?
3,000.
Half of that is?
1,500.
1,500, 1,500. That's right. Or half Social Security income. I haven't given that to you. So let's say your Social Security income is $5,000. What's half of that?
2,500.
So which is lower?
The first one.
The first one, the 1,500. Let's say my Social Security income, I had just barely gotten started. Let's say it was 2,000 for the year. What's half of that?
1,000.
Which is lower?
1,000.
In this case, it would be half of the Social Security income. That's how you determine it. That's actually how you determine it. And then you'd write the taxable part on line 5B of the Form 1040. Now, what if it's above the additional amount? Well, what we're saying now is up to 85% is taxable. And as you've already learned, it's really not of the full amount, is it? It's really of the amount that's above the base amount, because you get to subtract out the base amount, right? Now, this calculation is really confusing. At this point, when you get above 85%, you're having to calculate like 2 or 3 different items and then compare them to each other. It's too confusing to do a shortcut. Just know if you get to the above the additional amount, use the Social Security benefits worksheet instead of trying to do a quick down dirty calculation. Okay? So that's how I really want you to do that calculation, is by using the benefit worksheet. But why do I tell you about this? Because you could quickly, almost in your head, if you have a calculator, you could quickly tell if somebody's Social Security is going to be taxable or not, and about how much. You'd quickly calculate total income. You'd already have the amounts memorized in your head to compare to base amounts and additional amounts, and then you'd know if it's below the base amount, it's not taxable at all. If it's above the base amount, it's partly taxable. And if it's above the base amount and below the additional amount, you know how to calculate that. If it's above the additional amount, you know up to 85% is taxable, and then you use the worksheet.
And that's 85% of their Social Security benefits, not their total income.
That's correct. Yeah, that's correct. Yes, and that's true with the other one too, the 50%. Well, you know what? Let me scratch that. That's not exactly. Can you see from up here, you are including total income, but they're taking whichever's less of those two. So it could potentially include some other income, but still it's always going to be less than your Social Security.
Yeah.
Okay. Because this calculation is kind of involved with this calculation down here, but it's much more involved. Okay. So what I'm really trying to say is, yes, we are focusing on Social Security. Technically, they look at your other income as part of this, but in the end, they're determining how much of your Social Security they're going to tax. So it is really only your Social Security we're figuring, but to figure that out, we have to include your other income. Okay. I hope that didn't confuse you, what I said there.
Nope.
So I tried to visualize this in a box, another way to help you remember. You have a line, the bottom line is your base amount. The upper line is your additional amount from up above. You just pull the numbers from up here. So if you're below the bottom line, below the base amount, $0 is taxable. If you're between the baseline and the additional line, up to 50% taxable. If you're above the additional line, additional amount, up to 85% is taxable. And that's it. So I'm just putting that up for, actually, I'm just going to put this up for now so you can't see anything. So if you're single, what is your base amount for Social Security?
25,000.
And what's your additional amount?
34,000.
Okay. If you're, what am I trying to say? If you're MFJ, what's your base amount?
32,000.
Yep.
What's your additional amount?
44,000.
Very good. If you're MFS and living with your spouse, what's your base amount and additional amount?
0.
That's right. Step 1 is to do what? What are you going to calculate in step 1?
Your 1/2 of Social Security income.
Okay, but what are we calculating?
Total income.
Total income. That's what I was after. You're right. Now, what goes into total income? There are 3 things that go into total income. First one is, you just said it, Noemi.
Yeah, 1/2 of Social Security.
1/2 is Social Security income plus
all other taxable income.
All other taxable income plus
any tax exempt interest.
That's right. It gives you. So now, step 2 is to do what? What do you do? Step 2.
Compare total income to base amounts.
Perfect. Now, step 3, if your total income is less than the base amount, how much is taxable?
None of it.
Not taxable, no.
If it's more than the base amount, how much is taxable?
Partly taxable.
That's right. So step 4, if it's partly taxable and it's between the base amount and the additional amount, what is the maximum taxable? What's the amount maximum that could be taxed of your Social Security income?
50%.
Yeah, that's right. That's the maximum. That's exactly right. If you're above the additional amount, what's the maximum amount that could be taxable?
85%.
Perfect. If you're between the additional amount, excuse me, if between the base amount and the additional amount, how do you calculate that taxable part?
Lower of
Okay.
50% of your social income, or 50% of your total income less base amount.
That's right. That's it.
Whichever is lower.
Yeah, that's right. No, that's exactly right. And how do you calculate it if it's in the 85% bracket? Above the
benefits worksheet. Social
yeah.
Security benefits worksheet.
Yeah, don't try to memorize it. So here's the thing. On a test, they might ask you, is this going to be taxable? Well, you could quickly run these numbers. If you got these, you could do this in like 30 seconds quickly, because they might give you like, here's the amount of income, earned income they have or whatever. Here's their Social Security. Is this taxable or not? You could quickly figure this without using anything they might give you. You could quickly figure it. That's all we're really after. I seriously doubt if they're going to have you calculate above the additional amount, they're going to have to give you the worksheet. And I seriously doubt they're going to do that. That's why I want you to memorize this little cheat sheet to help you out. Because this cheat sheet that I'm putting back up there, this cheat sheet is not only going to help you on the test, it's going to help you in real life. If you got this, somebody walks in and they say, well, I don't know if I got a file or not. Well, first of all, find out what their total income is. That's the first thing you need to know. Incidentally, if their only income is from Social Security, are they going to have to file?
No.
Have to file goes completely back to the first session that we did about what was the filing requirements. If their only income is Social Security, they don't have to file. Why is that? Because if they have only Social Security income and that's their only source of income, all of it's going to be exempt from tax. So that's all. Okay. That's really all I have for Social Security. Any questions about that? Nope. Pretty clear, huh? Okay. So notice I've put up the federal income or not again on your screen. We earlier today talked about the retirement from IRA distributions and retirement from other types. Now we just talked about retirement from Social Security, normally reported on a 1099, and this could be partly taxable, potentially taxable. That's what we're talking about. And by the way, potentially probably would have been the better word, so you might want to change that in there. Potentially taxable. It might or might not be taxable depending on whether or not where they fit in all of this. And if it is, it's only partly taxable. Now, look across the page. Social Security is not taxable in that other column when it's the only source of income, which I just described, or when the total income is below the base amount. Okay?
Okay.
All right. So that's all we got to be thinking about now for that. So can we make a mental shift for a minute? We're going to start going through. In fact, I'm going to go back to this one for a moment. I'm just checking something here. I'm coming back to here because now on page 3, we're going to be getting into a lot of under the federal income or not. We're going to get into a lot of the stuff that's on page 3 now, okay? So I just kind of want you to have that off to the side. So as we go through a bunch of list of stuff, I want you to be able to see it on the federal income or not page, how it's listed, and it'll help you keep straight. This next section is actually pretty easy. The hardest part is keeping straight. Which of them do you include in income and which one do you not include in income? That's the hardest part of this next section. This cheat sheet will help you. And Just like Garrett said, there's also one in your reading. That's where you got that from, right, Garrett? The reading?
Yes.
Yeah, I think I remember seeing that. I've tried to glance through the chapters in your reading, see what's there, and I think I remember seeing a similar sheet. So this is good. So now we're going to go into a slideshow talking about other income. It's basically all the other kinds of income that we have not yet discussed. So let's talk about state refunds, taxable state refunds, okay? Some taxpayers claim a standard deduction based on their filing status when determining their taxable income, while others itemize deduction. Now, have we actually taught standard and itemized deductions yet?
No.
I know you guys that are sitting here today on this live session know what they are, but I'm going to teach this as if you didn't, for the people that don't know. All I'm going to say about standard and itemized deductions is when you go to deduct, something we'll talk about, I believe it's next session we're going to get into this, but you can take a standard amount that you get to subtract from your income, or you get to itemize, which means list out specific expenses that you can deduct from your income. When you itemize, you have to follow special rules. Now, you can deduct specific things on there. We're not going to go through those right now, except to mention that you can deduct things such as property taxes and charitable contributions. Let me see. This is not what I'm after. This is what I'm after. You can deduct taxes on there. And state and local income taxes. Oops, I'm sorry, guys. Forgot I can't do it that way. You can deduct state and local income taxes from there. Okay, so here's state and local income taxes. So one of the things you get to deduct if you're going to itemize are state and local income taxes. What are state income taxes? Those are amounts you pay that are withheld based on the amount of income that you received. In other words, how amount of pay you received. This is exactly the equivalent of federal income tax. It's the equivalent. It's a different percentage, though, based on the state. So in Oregon, if you earn $1,000, you got to pay X number of dollars in state income tax. If you live in a place that has local income tax, it's the same thing for your county or city or where you live. And you do it through withholding. What is withholding?
That is the money that your employer withholds from your check and sends to the IRS on a quarterly basis.
Or in this example, to the state of Oregon.
Yeah.
Right? Because we're talking about state income taxes. What are estimated tax payments?
Those are payments made by like self-employed people to make sure they don't have excess amount owed at the end of the year.
Right. Right. And again, they would pay some to the IRS and they'd pay some to the state of Oregon. Okay. Or any other state that they're doing business in. Now, when a taxpayer receives a reimbursement for a refund for an amount that it previously claimed as an itemized deduction, it is called a recovery. That's a lot of words to say this. If I've got income taxes that I got to put on my tax return, my federal tax return, and the IRS gave me a break on that tax return, but those same taxes help me get a refund from the state, the IRS wants me to claim that money that I got from the state as income. Okay? So let me say this again. The worst part of this is just keeping straight which year we're talking about. Let's say in 2018, I paid $1,000 in state income taxes. Well, guess what? I got to use that on my federal itemizing deductions. I got to deduct that $1,000 from my federal income. Well, IRS is okay with it if I meet the requirements. But if I end up getting, say, a $200 refund from the state of Oregon for 2018, they want me to include that in my income, because if the IRS gives me a tax break for something it got no benefit and I turn around and got a benefit from it, they want to tax me on that benefit. Okay? When would I get my state refund? Would I get it in 2019 or 2018?
2019.
Yeah, that's when I'd physically get it because that's when I physically filed it. So if I got a refund from a state income tax in 2019, when am I going to have to include that refund in my federal return when I do my 2019 tax return? That's how I recover it. Okay, so I just want to stop for a second and make sure this makes sense. There's no exact easy way to explain this. It's just confusing because you're talking about different years. So, any questions with that? Or anybody have a different way, because I have some experienced people on the line, any different way you want to explain this that might help other people?
The way I remember it is if the taxpayer itemized their deductions for the previous year and they end up getting a refund from the state, they have to include that on their following year federal return as income. If they took the standardized deduction, they don't have to include it.
Very good. No, that's exactly right. That's very good. Yeah. Just remember, always look back to the prior year's tax return. Did they itemize or not?
Yeah.
If they did not itemize and they took a standard deduction, which you don't know anything about yet, but just remember those two words, itemize or standard. If they took a standard deduction, they did not itemize, don't worry about it. Don't include it. If they did itemize, see if they took state income taxes. If they did not, don't worry about it. Don't include it. If they did, you have to add that in, the refund from that state.
And that's the nice thing about Profiler is that if they're a returning client, it has that information already in there.
Right.
That's also a good reason why you want them to have a copy of their prior year return if they're a new client, so you can verify that stuff.
Yeah, and just to clarify for those that might not know, Profiler is our tax preparation software. You're right. And what it does is, so if a client comes back to us year after year, that information's already in there for you. You're good to go. Yeah. If they're not and they're a brand new client with you, you're going to have to ask them. And you could ask them, but I'm telling you, who remembers exactly what the amounts are? You always want to, if you can get it, get a copy of the prior year tax return, if you can. That'll tell you everything you need to know here. There are other kinds of recoveries, but this is the only one I want you to worry about, the state tax refunds. That's the only one I want you to remember.
Depreciation is a type of recovery, right? If you sell a property you depreciated, you have to recover that, right?
It's called recapture, not recovery.
Oh,
that's
okay.
called recapture.
Okay.
Yeah, it's different terminology, but truthfully, yeah, it's sort of similar.
Okay.
So anyway, let's use an example. Troy itemized deductions on his 2017 federal tax return and took a deduction for the 2017 state taxes he paid. Okay. In 2018, he received, that's when he did his return for 2017. Remember that. So he received a refund from his 2017 state tax return. Depending on his situation, Troy might have to include his state refund as income on his 2018 federal return. Now, as a general rule, in this situation, I would have said this a little differently. I would say Troy most likely has to include it on his return. There is a calculation you actually calculate something out to determine if all of it is going to be included. 99% of the time, anybody in this situation of Troy's is going to have to include all of it in their return. But there are circumstances where they might not include all of it. Am I interested in you really calculating it absolutely accurately for the sake of the test? No. In real life, I'm interested in it, but I'm not going to get into it that deep, because if you understand that it most likely is going to have to be included, you'd be able to pass the test. And again, right now, I'm trying to get you so you can pass the exam. Once you actually get started with real life, will help you a little bit, calculate these things. Okay. So a taxpayer who does gets a state or local refund is going to get what's called a Form 1099-G, certain government payments, 1099-G. Box 2 shows state or local tax refunds, credits, or offsets. In other words, state refund. So if you got a refund at the end, or if you got a refund this year when you're doing your 2018 return, you're going to get one of these next year around January 31st of 2018. Let's start again. If you did your tax return for 2018 and got a state refund in 2019 for your 2018 return, come on January 1st, 2020, next year, you're going to get one of these, and it's going to have an amount in here. And that's your refund amount. Now, while we're here, just for fun, since it's easy to see, notice this is also used for unemployment. If you drew unemployment during the year, you'd also get this for that amount. But anyway, that's not what we're talking about now. Okay, so none of the state tax refund is taxable in the year the taxpayer did either of these. Either did not itemize deductions, or they itemized but did not take state income tax. Okay, so we've already kind of covered that. Again, if you don't itemize, don't add. If you itemized but did not take state income tax, don't deduct. If you did either of those, you are most likely going to have to include all of that refund in your return the following year. How do you actually calculate it? You calculate it using the state and local income tax refund worksheet, line 10, to determine whether any of it's taxable. And that's the one I'm saying you'd go through calculating it. Once you figure it out, then you report the taxable amount of it on Schedule 1 of Form 1040, line 10. So don't memorize the line numbers for this. Just remember, you do it on the worksheet and then carry the amount to Form 1040. That's really what I want you to remember. So I think they're doing a quick example, and we'll look at it, kind of a high-level overview. So Nigel filed his 2017 state tax return and received a $200 refund in 2018. State refund. And by the way, you can see that down here. There's his 1099-G. There's the $200 that we're talking about. Nigel's filing status is is single for 2017. He has total itemized deductions on his 2017 of $8,525, which includes state income taxes of $1,197. So what is this telling us? In 2018, when he did his 2017 return, he itemized. He has this amount of total itemized deductions, and he did include this amount of state income taxes in there. So did he get a benefit from the IRS for the state income taxes?
Yes.
Right. If he gets a federal refund, or if he got a federal refund in 2018 for this return at the state level, is he going to have to include at least part of this in his income?
Yes.
Yes, he is. Nigel received taxable pension of that amount. He has no other income. So there's the worksheet. And I'm not going to go through all of this other than to point out some numbers. There's the refund he received from the state. There's his total itemized deductions. This is an amount that they determine. I'm going to tell you this is standard deduction amounts. That's what those are. Those are old ones, not new ones, not current year. Those are old standard deduction amounts. That's what those are. And all you do is you look over here and say, he's single, so that's the amount I write there. Did you fill out this particular line on the Form 1040? No, you mark that no and put 0. 3 minus 4 equals 6,300. Now all we're doing is we're starting to do some comparisons. Is the amount on line 5 less than the amount on line 2? So is the standard deduction less than the total itemized deductions, exemptions?
Yes.
Wrong word, right? I said exemptions. Is the standard deduction amount less than the itemized deductions is what I meant to say. Yes, it is. So subtract the difference. That's the difference. Which is smaller? The difference between standard deduction and itemized, or
amount of your refund.
The amount of the refund.
Yeah, that's
so I don't really want you to, here's the thing, just remember what they're really doing is they're just taking the amount of your itemized and subtracting out what everyone gets. In this guy's case, it would have been 6,300. The difference becomes the maximum amount that you could take as that you would be taxed on. So if he had a refund of $3,000, this would have, if this amount had been $3,000, then it would have been capped at the difference. So that's why I said you don't need to know all that to pass a test. If they ever had you calculate it, they're actually going to give you this little sheet, but I don't think they're going to have you calculate that. They're going to ask questions about the rules around it. So Stan and Juanita are married. They file a joint return and state returns. They file joint federal and state returns for 2017. Their total itemized deductions from their 2017 are $18,501, which includes state income taxes of $3,823, and they received the 1099-G shown. So how much state refund did they get?
$1,762.
$1,762. Noemi, where did he get that number from?
From from previous year.
That's true, but I mean, what are we looking at? What box do we look at for that information?
Box
2. That's right. Box 2 right there. That's exactly right. Okay. So how much is he first of all, let me ask you just a few questions. What is the amount? Well, you already answered the first question, actually. The first question is how much is their state refund? $1,762. A prior year state refund may be taxable in the year that it's received if which of the following? A, B, C, or D?
I cannot say A, B, C, D.
Okay, I'm going to wait for a second.
Sorry.
That's okay. Don't worry about it. It's okay. Let me know when you have it, okay, up, so you can read them.
Okay.
Okay.
If the taxpayer itemized deductions in the prior year.
Exactly right. Good job. All right, so here comes the next screen. It says taxable state refunds are reported on which place. So again, let me know when it's come up for you, Noemi.
Schedule A.
Okay, taxable state refunds are reported on which item? Where do you report a state tax refund? The taxable part, I mean.
Be under wages and salaries and tips, wouldn't it? Income?
Okay, let me help you. It is
Itemized deductions, or can we?
No.
Schedule A, right? Line 5.
No, that's where you report the deduction. This is asking taxable state refunds that you have to put in as income are reported where? See?
Okay.
So look at you guys. You have your form 1040s in front of you in the Schedule 1s. Look at those. Tell me which one it goes on. Take a look at it.
Schedule.
I go with line 1.
Line 1.
Sorry.
I'm not sure what you meant. That's all.
Okay.
Line 10. Schedule 1, line 10.
Okay, that's her answer. What did you get, Garrett?
Yeah, Schedule A, line 10. Okay.
No, that's exactly right. Now, guys, I don't really want you to memorize what line numbers. What I'm trying to get you to understand is, and make sure that you understand for testing purposes, on Schedule A from a year ago, if they itemized and put income tax in there as a deduction and got a state refund, this year they're going to have to add it into their income, and income is done on Schedule 1 and the Form 1040. That's the point. I don't care that you memorize the line number. Just know you got to add it into your income. Okay?
Yeah.
All right, so let's look at this one. Wendy filed her 2017 tax return and received a $10 refund in 2018. Her filing status in 2017 was head of household. Total itemized deductions from Wendy's 2017 Schedule A are $11,744, which does not include state income taxes. How much of Wendy's state refund is taxable on her 2018 return?
Zero.
Okay, and
Yeah.
you're exactly right. Why is that? Why is it zero?
She didn't have any state income taxes included in her.
There you go. Exactly right. Perfect. All right. Now, remember to keep your income or not sheet handy as we go through this, because now we're done talking about that. Now we're going to talk about alimony, and alimony is on that sheet. So generally speaking, alimony, give me just a second here. I want to pull something up on my end that'll help a little bit. Give me just a moment, guys. Sorry about this, but this will help me help you if I got this pulled up. Okay, there we go. All right. So alimony. What is alimony? Alimony is a payment to or from a spouse or former spouse under a divorce or separation agreement. Okay. Alimony means these are payments that are required by law, and as long as they're considered alimony, it's going to be alimony for tax purposes. If these payments can be deducted by the paying spouse, then they are deductible or includable by the receiving spouse. So let's talk about this a little bit differently. Alimony are payments that a court requires you to make to an ex-spouse. That's all they are. They got to be designated as alimony, not something else. Okay? There's certain requirements for them to be alimony. Okay, and we're going to talk about that in a minute. And here's the thing, alimony is generally included in income, or not generally. Alimony is that you receive is included in income. So if you receive alimony from an ex-spouse, you have to include it in your income. But the person paying it gets to deduct it from their income. Okay?
Yes.
All right. So what payments are alimony? We're going to focus almost purely on the left side. Everything on the right side says what is not alimony. Well, pretty much anything, the right side is the other side of the coin from the left for most of this. So payments are alimony if these things are true. The payments are required by a divorce or separation instrument. In other words, by a court. That the payer and the recipient do not file a joint return with each other. Because remember, you can have a separation, legal separation with alimony in it. And if you go and file a joint return, obviously you don't get to deduct it. That'd be silly. You'd be deducting it and she'd be adding it in on the same return. That makes no sense. Payments must be in cash. That can include checks or money orders. Now, jumping over to the right side, you do not include in alimony non-cash property settlement. In other words, you had to give certain property over, real estate over it. Let's say you had to give a house over to the ex. That would not be alimony. That's a settlement of the divorce. It's not alimony. You do not include the spouse's part of community income. In other words, if you both are dividing it half and half, you only get to the only part that's alimony is the part that's yours that you're paying to her, not your part. And you do not include money you pay to keep up your property. So maybe you own the house, but the divorce agreement says she gets to live there for the next 5 years or whatever. But you still have to pay for that property. That property is still your property, and you don't include that. So do these things happen very often? No. Just kind of be aware of them just in case you get a question about them. So back to the left side, payments in cash. That's alimony. It has to be payment in cash. The payment cannot be designated as not alimony. In other words, it cannot be designated as something else. For example, child support. Spouses legally separated under decree of divorce or separation are not members of the same household. If you're going to, you can have a divorced couple that are living together. If they're living together, then you cannot, then you don't have alimony there for tax purposes. You still may be required to pay it by a law, by the court decision, but you are not required to put it on your return as income, nor is the other person, the payer, allowed to deduct it. Payments not required after the recipient of the spouse. In other words, after the death of the recipient spouse. What that means is for something to be true alimony, it has to stop at the date of the recipient's death. True alimony is to support the person while they're alive or till they get remarried. It does not allow it to continue after death. If it continues after death, it's not considered alimony, even if they're calling it alimony. Payment that's it's got to be a payment that's not treated as child support. You could have something where a court says, okay, you got to pay $1,000 a month to your ex, but if all $1,000 is really child support, then there's no alimony there. Okay. Oops, sorry. I jumped past some stuff here. There we go. And these payments are deductible by the payer and includable in income by the recipient. We already said that. So those are the basic things that are required. Look, the real things to remember, it has to be done by a court in the form of a divorce or separation agreement. They cannot be filing jointly or living together and filing separate returns. The payments have to be in cash. They cannot be in the form of like property. And you can only include cash for your part of something that's jointly owned. And it cannot be designated for something else like child support. And child support is the big question that there's a good chance you'll get one like that on there. So as far as what it takes to have alimony, any questions about that?
None.
None? Okay, good enough. All right, let me do something else here for a sec. Sorry, guys. I'm messing with something here. I'm going to mess with something more for a second. I've lost something on my screen, and I'm just bringing it back. That's all I'm doing. There we go. Okay. All right. So the next screen. Let's look at this example. Under Xander's and Elena's separation agreement, so they're still married, but they're separated. Xander must make the mortgage payments on a home owned by Ilana. I said Elena, Ilana. So who owns the house, Ilana or Xander?
Join.
What does this say?
It's owned by Alana.
Ilana.
That's right. So owned by Alana. That's right. So if these payments and Xander's making the payments on it. So if these payments also meet the other qualifications for alimony, Xander can deduct the mortgage payments he made as alimony paid on the return because it was required and he's not the one owning it. It was required by divorce decrement and he's not the one owning it. So those payments he gets to deduct and Alana must report them as alimony received. Now, for jointly owned home, this is where I was saying, and really what I want you to do is just focus on just this line here, if you can see it. It just says, if you have mortgage payments, principal and interest, and your home is jointly owned, then you can deduct half the total payments. Okay? The other half of the payments. Okay, why? Let me rephrase this. You can deduct as alimony half the payments. Why is that? Why only half?
It is jointly owned.
It's jointly owned, so they both own half. So the payment that he's making, that's her part of the payment, is alimony to him. He's paying it out of his pocket, but that's her part. He's paying it for her. That's alimony. What about the other half that he's paying that's his part? He gets to itemize that. He can put that down as an itemized deduction. It doesn't matter if he was living there or not in this circumstance. See? Because that way he gets to deduct the full amount. He gets to deduct the half that's alimony because he's paying that half for her. His half, he cannot deduct as alimony because that's his half of the ownership. Yeah. But if he's paying it, he still gets to deduct it. He just has to itemize it to get that other deduction. Okay? And it's basically the same for real estate taxes. That's all. I'm purposely kind of jumping over this because this is more detail than you need, I think, to pass the test. So let's use another example from Xander and Ilana. They own their home jointly, let's say. So in this example, Xander and Ilana jointly own their property. Xander can only deduct half of the mortgage amounts he paid as alimony on his tax return. Why is that? I told you a moment ago, why can he only deduct half of it? Because he's paying what?
His part.
He can only, let me rephrase the question. I think the way I asked it confused you. That's okay. It's because the way I asked it. He can only deduct as alimony half. He can only deduct half that as alimony. Why can he deduct only half of that as alimony? Because he's paying his part or her part?
Her part.
Because he's paying her part. That's not the part he's actually responsible for. He's paying her part for her because the court order said it. That's alimony, so he gets to deduct that as alimony.
He gets to deduct the other half as his mortgage payment, and so but not as alimony, but as his
right, as if it was his personal expenses, or not as if it is. He gets to deduct the other half as a itemized deduction. Now, what would Ilana do with the half that he paid for her? What does she have to do with that alimony?
She has to report it as income.
That's exactly right. Are you with us, Noemi, on this?
Yes.
Okay. All right. Payments not considered alimony. Not all spousal payment. I kind of touched on this a moment ago. Not all spousal payments that are made or that are even included in a divorce are considered alimony. For example, child support is not alimony, even though it may be in there. Non-cash property settlements, we mentioned that before. Payments for the upkeep of the payer's property. The husband maybe has to pay for certain repairs and upkeep of the house that his ex is living in. That's not necessarily going to be alimony. It depends on the circumstances. Use of the payer's property, payments that are considered part of community income and designated in a community property state. So look, there's a list here. Kind of be familiar with them, but what I really want you to remember is child support is not alimony. Non-cash property settlements are not alimony. That's what I really want you to remember for testing purposes. So if Xander owned the home by himself, in other words, he's the sole owner, but Alana got to live there underneath their separation agreement, Xander's mortgage payments will not be alimony. Why won't they be alimony now?
Because they're living together.
No, it doesn't say they're living together.
Well, Xander owned the home, but Elena lived there under the rules of the separation agreement.
Right.
That's where I was thinking there must both.
No, it's okay. It's okay. I'm just having you think through this. So Xander's mortgage payments will not be alimony because he's the owner of the property. He's not paying anything for her.
Oh, okay.
Okay.
Remember, it comes back to that. Who owns the property and who's paying for whom? So remember in the very first example, she owned the property, he's making the payments. So 100% of the payments are alimony. When it's split and they're 50-50 owner, he only gets to take half of it as alimony. Now he owns 100% of it, so he gets to take none of it as alimony.
But it says he could not deduct the payments on his return. He could deduct them as mortgage payments, not as alimony. And so,
let me double check this slide. I read through it, but again, I didn't make these slides.
Yeah.
We live in this under separation agreements. Oh yeah, they mean alimony payments. That's what they're saying.
Yeah, but they said that up here, and then they say it again.
I know. But that's what they mean.
Yeah, but he could deduct it as mortgage payments.
Yes, he can. Yeah, I know. It's confusing because there's two different kinds of deductions. Deduct as alimony payments on his return. That's what they're saying he cannot do. And as a result, Alana would not report it as alimony income.
Yeah.
So that's what they're saying. And you're right. He could still deduct it as personal, as a personal itemized deduction. You're 100% right. So Candy received $1,200 per month in alimony from her former spouse, Josh. Let's say they meet all the qualifications for that to be considered alimony. Candy as a recipient will report 12 months times $1,200 is $14,400. That's the amount she'll report as income. What will he report as alimony deduction?
The same.
The same. That's exactly right. Yep. And we don't care so much where it's reported right now, other than I will point out he takes this as an adjustment. Remember on the Form 1040, we talked about income minus adjustments gives you adjusted gross income, or AGI. Income minus adjustments. This is one of those adjustments. And remember, we keep coming back to that. And by the way, on the newer form starting in 2018, where on the Form 1040 do you do adjustments? Where on there, where do you list your adjustments?
Schedule 1.
Schedule 1, the lower half of Schedule 1. That's exactly right. And whenever, oh, go ahead.
Alimony paid, line 31A, and you got to put the recipient's SSN in there too. So.
Yep. That's right. So in this example, and Candy's social security number has to be put on there. Okay.
Yeah.
If the taxpayer pays alimony to more than one person, you have to add all the payments together for all the recipients and report it on that line. So if, like the song, how's the song go? All my exes live in Texas. So if all your exes live in Texas, then you add them all together and you report it all as one lump sum. And then when you're reporting social security number, you just list the first person on the Schedule 1, and then you just attach a sheet listing all the others. Now, the alimony recipient is required to give the taxpayer their Social Security number. If they don't, they can get fined for it. So can you. So real life, you should work that out the best you can. And that's tough because occasionally you run into situations where somebody can't get it, and then they have to go through the IRS for assistance. So that's reporting alimony. Okay? And you'll notice on your federal income or not, alimony received is on included income column. Okay?
Yes.
All right. So child support. Child support payments are not taxable, period. Payments that are treated as child support when specifically designated under a divorce separation agreement, that's what child support is. This is not 100% accurate, the statement, the way they did this. You can have child support ordered by a court, which is under a divorce or separation agreement. You can also have it ordered under a paternity suit by a court. You can also have it ordered under certain rules of the state. The state of Oregon oftentimes has the Department of Justice handle this, and it never goes into a court situation. So this is not 100% accurate. Child support, though, is not just money you give to your ex for your child. It's money that's required by law or some official order from an official place to be paid. And then there's always, oops, sorry, I've done that more than once. And then there's always contingency events that will stop the child support from running. For example, the child passes away, God forbid, but that can be one example. So those are all situations. So on your federal income or not sheet that I sent you, the 3 pages, which column is it in? The include in income or do not include in income?
Do not include.
Do not.
Perfect. Perfect. Okay, so let's go through a knowledge check. Under the terms of their divorce agreement, Leanne made a payment of $3,000 directly to the college for her ex-spouse's tuition. Okay. Leanne can report which of the following on her tax return? And if it hasn't shown up yet, that's okay. No, Emmy, just let me know when it does show up, okay?
Yeah. Leanne, 3,000 deduction as alimony paid.
Yes, that's correct. That is correct. Let me get to it. There we go. 3,000 deduction. Why? Because that's alimony, because this is money coming out of Leanne's pocket. I was making sure I had the name right. Leanne's pocket, and it's being paid for her ex-spouse's tuition. So that's alimony. And it was required. Okay, their divorce instrument requires Tony to pay Florence $5,000 per year for spousal support. Spousal support is another word. In fact, in Oregon, they call it spousal support. They do not call it alimony, but it means the same thing. He paid that amount, but also gave Florence an additional $2,000 during the year because she fell on hard times. How much must Florence report as alimony income on her return, and how much can Tony deduct as an adjustment to income on his return, respectively?
$7,000.
And what did you get, Garrett? Which of those answers are yours?
I put down B for this one, 5,000 and 5,000.
Okay, it's 5,000 and 5,000. Why is it B and not 7,000 and 7,000?
Because the court orders for 5,000. The additional 2,000 is money he gave her,
right,
out of concern for her well-being because of her hard times. It's not
that's
actual.
right.
If they agreed that they could include it as together, include it as alimony on the taxes, that might be possible, but I don't
think still, actually, even then, an agreement would not be enough. They'd have to get a court to order it, or an agency to order it.
Yeah.
So here's the thing.
He's not going to want that. So.
No, the additional $2,000 is a gift. He just gave her a gift.
Okay.
Yeah, see, it's all about what's on the divorce instrument. And I'm going to say divorce instrument, but it can include a separation instrument.
Court order.
Yeah, exactly. Okay. So Jose paid $3,600 of alimony and $6,000 of child support to his ex-spouse Gina as required under their divorce instrument. Use this information to answer this question. What amount must Gina include as income on her tax return?
$3,600.
And yep, you guys both have the right answer. Good. So the next question, on which line of Gina's Form 1040 is her alimony income entered?
Schedule 1. Oh, sorry.
Go ahead.
It's line 11 on Schedule 1.
Yeah, no, that's exactly right. Now, again, if you were to look at the Schedule 1, and I'm looking at it right here, it shows it. Do I really want you to memorize that? No. What I do want you to remember is that it goes into the income section on the 1040. That's what's important for Gina. Okay. What amount can Jose deduct as an adjustment on his tax return? Do you happen to remember the amounts?
3,600.
Yep, that's exactly right. 3,600. He can deduct what she has to put in. See, the IRS almost never lets you double dip. If one person gets to take a deduction, somebody is going to have to pay taxes on that, and vice versa. So she has to include this in her income, but he gets to take a deduction for it.
That's going to change. I didn't bring it up earlier. But
I know.
It's going to change in the future. I'm not sure how far down the road.
I don't remember either, but for 2018, it has not changed.
Yeah.
And I don't know what's going to happen with it. Just to let you know, though, I'm pretty sure that just to let you know, guys, I think they're getting rid of alimony altogether, all the way around. And
it was going to go the way of child support, not be taxable or anything.
Or anything, yeah. Which is good for the recipient, but bad for the payer.
Yep.
Anyway, but it's what it is right now.
Yeah.
So, on which line of Jose's 1040 is alimony deduction entered?
Schedule 1. Line 31A.
Yep.
Perfect. That's exactly right. Again, don't really memorize that, but you know now that that's part of adjustments.
Yep.
Okay, that's what's important. It's part of adjustments. All
so
right.
if they want us to know like a line number or something, they'll give us the form, right? Not.
Most, it's hard. I hate to definitely say yes or no on something, but I cannot see them asking you to memorize line numbers, especially with all the changes to the forms this year.
Yeah.
So I don't think so. I think they're testing for concepts. And when they do want you to calculate something, you got 100 questions to go through. And I don't think they're going to, in a certain amount of time, I don't think they're going to be asking you to do a lot of complicated forms. I think they're going to ask you to do simple, when there is a calculation on something, I think they're going to ask you to do a simple calculation. Okay?
Mm-hmm.
All right. So, let's talk about some miscellaneous income. What are the ones we're going to talk about? Life insurance proceeds, public assistance benefits, workers' comp, gambling winnings, hobby income prizes, canceled debts, other miscellaneous. Look, I'm going to go through these relatively fast because keep in mind on your income or not, your federal income or not sheet, it's listed there to help you keep straight. Because remember, the only two things you need to know about each of these is what does it mean, what does life insurance mean, and is it taxable or not? That's all we're interested in right now. So you can use the cheat sheet that I gave you to help you keep this straight. So life insurance proceeds. These are life insurance proceeds paid directly to the taxpayer because of the death of an insured person are not usually taxable unless the policy was turned over for a price. So life insurance, if I buy life insurance, I'm going to name my spouse or I'm going to name somebody else as the beneficiary, the person who gets the money. That's the taxpayer they're talking about. So if you get a life insurance policy, not a policy, excuse me, if you get payment out of a life insurance, say $1,000 or $10,000, let's say you get $10,000, you're going to get that $10,000 free and clear. It's not going to be taxable. A policy turned over for a price, don't worry about what that is. Just remember, it would make it taxable if you turn a policy over for a price. It's basically where they sell it out and you get some money. Just know the terminology. Policy for a price would make it taxable. That's all I want you to remember. Earnings that you receive when the proceeds are invested is taxable. So say you get the money, but they've been holding it in a savings account temporarily while they work out all the since a death, while they work out all of the ways, what am I trying to say, all the legal maneuvers to get you the money, they might put it in an investment account. Well, if it's earned some interest there, you're going to have to pay taxes on the interest. Why is that? Remember the terms that I used several sessions ago, new money versus old money? The old money is the life insurance policy. That's part of what the person bought for you. So those life insurance proceeds, think of those as old money, but any new money earned on it, like it's invested, you're getting interest on it. That's new money. You have to pay that just like you would any other interest. Does that make sense, that distinction?
Yes.
Perfect. Public assistance benefits. Look on the right side. These generally are not taxable. These are benefit payments like from public welfare fund or from victims of victims crime fund, disaster relief payments. Those are the kinds of things that would be under public assistance. Generally, they're not taxable. Obviously, if you were working on the left side, it might be taxable if you happen to get a welfare payment that was actually compensation for some work you did. Well, duh, but then it wouldn't really be a public assistance payment, would it? So I think it's really kind of dumb to talk about that. That's all you got to know. Public assistance benefits. Give us one or two examples of what in Oregon, what a public assistance benefit might look like or what they're called.
Food stamps.
Food stamps. Yeah, absolutely. You also have, what's that money one? I forget what the money one is.
TANF, temporary aid.
TANF. That's what I was thinking of. Assistance for housing would be another one. That's a public assistance. Those are in the do not include column. Okay. Workers' comp. What is that? Well, amounts. First of all, if you get disabled for some reason and can't work, if you're getting some payments directly, and usually it's from actual disability or damage or something that happened on the job, that's usually when these will kick in. If that happens and you're getting some compensation from them, it's not going to be taxable. Amounts received as workers' compensation not taxable if paid to the worker under a compensation act or statute. In other words, it has to be part of the law and you were covered by that part of the law. So if you were covered by it, then it would be included. So like this little guy here, he was wheeling a wheelbarrow while he was working at work and he hurt and his back went out. Well, he'd be covered by workers' comp. Workers' comp insurance is actually paid by your employer, the insurance payments. So when all's said and done, this is one of those times where they're going to give you a break and say, okay, you're getting the break. You're going to get it tax-free, but who had to pay for it? Your employer had to pay for it. So in retirement plan benefits, okay, these are retirement plans. If you get, what they're trying to say is if you get disability from retirement plans, disability, it happens from a retirement plan when you're not retirement age yet. And so, but you start drawing disability early. In that situation, they are taxable, but that's disability. That's not the same thing as workers' comp. Workers' comp comes from injury on the job. You get paid. It's covered under the law, and taxes and everything are covered basically by your employer for it. So they give you a break. But that's not the same thing. If you start drawing retirement because you can't work, you are going to get taxed on that. Okay, gambling winnings. Gambling winnings include things from lotteries, raffles, so on, are taxable, and you always include the fair market. If it's cash winnings, it's easy. If it's something you win like a car or something like that, you put in the fair market value. You will get a W-2G, a form W-2G reporting it if it meets certain amounts. If it's under these amounts, then you're not going to get a W-2G. If you don't get a W-2G, but you did have a winning, are you still supposed to include that in your income?
Yes.
Absolutely. Do I care if you memorize these amounts for W-2G purposes? No, I don't. This is not that critical. It may be helpful, to know this, but it's not critical. So you include the amount of money you win or the what of bonds, cars, and houses and other non-cash winnings. If it's not cash, you include, right, you're right, fair market value. Okay, so gambling winnings are generally included in income. And there's an example of a form W-2G. Some gross winnings were in there, $1,350. He won it playing bingo. And then you report it right on Schedule 1, 1040, line 21. Take a look at line 21 on your Schedule 1 of the 1040. What does that say? What's the name of that line?
Other income.
Other income. Look, line 21 is a catch-all category. If it doesn't fit on any of the other income lines, you put it on line 21, and you'll see that with a lot of these income. What about hobby income? Special tax rules apply to hobby income. Look, when you have a hobby, you're not really doing it intending to run a business, but you still might sell some stuff. Somebody might like what you're making, and you occasionally sell it just to help pay for the cost of doing the hobby. Are you trying to run a business when you're doing that?
No.
No, you're doing it for fun. You're just selling stuff as a way to sort of get it to support itself. Hobby income is income. You have to report that. That is taxable income. You report that on, guess what? Line 21 again of the Schedule 1. That's other income. You can take a deduction for this, similar in some ways as you do for a business, but your deductions, first of all, the deductions have to be related to doing the hobby itself, like buying the supplies or something, and it's limited only to the amount of income. Can you take, when you're running a business, can you take a loss on that business if you have more expenses than income for the year?
No.
On a business? I'm jumping around to a business, a self-employed business.
Well, there's some circumstances you can and some you can't, from what I was reviewing.
Generally.
Right on schedule.
Okay, that's okay. Let's say generally, when you're running, you're self-employed and you're running a business, can you take losses? Generally.
Yes.
Yeah, you can. You can generally. If I have a $5,000 loss from my business, now again, I'm not talking hobby income. I'm talking business. I'm running. I'm mowing lawns, and let's say this year just things I had to buy a bunch of equipment and everything, and so I have I'm showing a $5,000 loss this year, but I have $20,000 of other income. So from maybe working on a regular job, I have $20,000 of income and a $5,000 loss. Can I take that loss as a subtraction from my other income?
Yes.
Yes, I can. So my total income would be $20,000 minus the $5,000 loss leaves me with
$15,000.
$15,000 income. Now, the reason I brought that up is because hobby income is different. You still can take the costs as a deduction against it, but you cannot go any lower than zero. So if you have $100 income and $1,000 of hobby income, and $1,000 of hobby expenses, how much of the hobby expenses can I take?
$100.
$100. That's it. That's all this is saying. Prizes. Prizes are includable in your income. Prizes, a taxpayer, is something that you win from a drawing or radio program contest or other events. These are all taxable. If you win something other than money, you take what? It's
Fair market value.
fair market value. And you report that on, guess which line of the Form 1040 Schedule 1?
21.
Line 21.
That's right, other income line. That's right. If the taxpayer refuses the prize, then you don't have to include it. So if they just won something and realize, you know what, that'll knock me into another tax bracket, I don't want it, then you don't have to include it because they've refused to take it. So an example, Michelle won a $50 prize in a photography contest. She has to put that on her income. So she does it here on line 21. She writes cash prize and puts $50 right there.
So, well, never mind. I don't want to confuse things.
Okay. Is it a question? Okay, I'm not sure whether or not to encourage you to ask it or not. So, because I don't know what you're
It's kind of out of
asking.
left field. So, it doesn't have to do with what you're teaching us. It has to do with my understanding of things with the tax code. So,
Okay. Why don't you hold on to it then? You can ask me separately, okay?
sure.
Okay. Canceled debts. Okay. Generally, a debt that the taxpayer owes that is canceled or forgiven is taxable. Now, we are not talking about where maybe you owed money, maybe you owed me money, and we had it genuinely, I intended for you to pay the debt, and in the end, I decided, you know, I'm not going to. I want to do something nice for you. I'm going to gift to you forgiveness of that. That would be a gift. A bequest is what's done through a will. So maybe there's some money you owe to somebody who passes away, and he specifically has in there any money that's left over when I die, or that you still owe me when I die, is forgiven. A gift or bequest doesn't count. But any other genuine debt that a taxpayer owes that ends up being canceled or forgiven is going to be taxable. If it's $600 or more, the person who forgives the debt is required to do a cancellation of debt form, a 1099-C, cancellation of debt. A canceled debt is taxable because the taxpayer usually retains the value or benefit of the debt. Look, the way to think about a canceled debt is, let's say, for example, you owe $5,000 on a credit card. And the credit card company just determines you're not able to pay, and it says, okay, we're going to cancel the debt. We're going to wipe it off. Think of the canceled debt in that case as them giving you $5,000 to pay it off. Think of it that way. If they gave you $5,000, would that be included in your income?
Yep.
Yes.
Yeah. So a canceled debt is doing just that. They're essentially giving you that money to pay off the debt. And that's the way you think of it. That's why it's taxable. Okay. And in our example there, it's $600 or more. So are they going to get a cancellation of debt form?
Yes.
Yes, they are. And there's an example of a cancellation of debt form. It says cancellation of debt, has 1099-C on the bottom. And in this example, it shows the date of the identifiable event to be March 20th. And the amount of the debt is how much?
$5,259.
Went rounded. It actually is 258.99.
Yeah.
But when you report it on the tax return, you do round it to the nearest whole dollar, 5,259. Notice how on line 21, again, it goes there under other income, and you write cancellation of debt. You seeing a pattern here? These little things you put on line 21, you write what it is, and you put the amount. Okay?
Why is it only one line? How about if more than one line?
What do you mean more than one line? Oh, you mean like if you have like two different things to put on line 21?
Yeah.
You would just add them together and put them both on there and write what you can on that line. That's what you do. Our computer would actually also add an attachment with other things that you've listed as well if you ran out of room. So add a page with a list if you run out of room. Does that make sense, what I just said?
So you will attach another sheet?
Yeah, you might. You might. But if you can fit them both right on the same line, you could do cancellation of debt, comma, whatever else, you know,
Winnings.
yeah, gambling winnings, comma, gambling winnings, and you just add it all together. If you can get it all on the line, do it. But if you run out of room, you attach a sheet just to say where it came from. Okay?
Okay.
All right. So awards and bonuses, cash awards or bonuses received from an employer are taxable. So, you know, our company, you guys earn bonuses, and then at the end of the season, we pay you bonuses. That gets added into your W-2 income, and they're treated as wages, and you get taxed on that. Same thing with cash awards. So cash money, cash bonuses, all that. If you get some kind of award that's not cash, you include the fair market value of the award. And again, that's nothing really surprising. We've already seen over and over again, include in income fair market value of goods or services you receive in certain situations. And certain non-cash employee achievement awards are not taxable at all. So if you get, for example, we might give you a certificate of achievement on a piece of paper. That's not worth very much. So the IRS does not require us to put that in your income. If you get a little plaque or something that just recognizes an achievement of some kind, again, that would be a non-cash employee achievement award, and that's not going to be taxable. And on your federal income or not, do you see where it says cash awards and bonuses generally? So that's the federal income or not handout that I gave you. Remember I said keep that handy?
Yeah.
I want you to take a look at it. I just want you to lay eyes on it for a second.
Yeah. Prizes,
See it?
awards, bonuses.
Yeah, and generally it's taxable, but look across the way, non-cash employee achievement awards, they're not taxable. So just wanted to show you that, okay?
Yeah.
All right. We're going to move on. Court awards and damages. This can be kind of confusing a little bit, but it's not really that bad. To know what to include in income and what to not include in income, think about what it's replacing. If it's replacing something that would get taxed, like if it's replacing earned wages are taxable. So if it's replacing earned wages, it's taxable. Okay, something for example. So settlement awards, taxable settlement awards, in other words, the ones that get taxed are these: compensation for lost wages or profits. Well, do you get taxed for your wages on your wages?
Yes.
So if you get compensated in a settlement for your wages, do you think that would be taxable?
Yes.
Okay, punitive damages. What are punitive damages? Does somebody have a definition for me of what a punitive damage is, or at least an example?
Are punitive damages meant to punish the person who?
Yeah, it's a way to punish a company or an individual for acting so wrongly that they want to make a point to them and anybody else who might be tempted to do the same thing.
Yeah.
Punitive damages are when you hear those huge awards for things like smoking, things like that, the smoking damages that cigarette companies have to do, things like that. Those are punitive damages. Those huge damages in the millions of dollars, those are punitive. They're meant to punish. Think of a punitive damage as winning the lottery, because believe me, when you go to court and get a multi-million-dollar punitive damage, you have won the lottery. If you won the lottery, would you get taxed on your lottery winnings?
Yes.
Yes. So if you win the lottery by getting punitive damages, which can only be awarded by a jury, are you going to include those in your income?
Yes.
Yes. Okay, interest on any settlement award. Sometimes a settlement, while it's working through the court process, has to, the company will pay money into this escrow account, and it might sit there for several months while all the details are worked out. While it's sitting in that escrow account, it's gaining interest. Do you pay interest? Do you have to include interest, any normal interest in your income?
Yes.
Should you include interest from a settlement on a settlement award?
Yes.
Okay, there you go. That's my point right there. So, okay, so on your income, federal income or not, it has those three things listed. I'm looking off the side at another, if you see me looking sideways, because I'm looking at a screen across the room. You have court awards under the taxable column, court awards, reimbursed for lost income, punitive damages, and interest paid on a settlement. Okay, just wanted you to point that out, or wanted to point that out to you. So now look over at this yellow column, orange column. It says compensatory damages. What are compensatory damages? Compensatory damages are to compensate you for an actual loss. Okay, compensation for an actual loss. So it's putting you back where you were before this person did this. So these are awarded to reimburse you for a loss, which can be an economic loss if you had a contract, or a personal loss, such as physical injury. And it can be received for personal injury or sickness. Now, these are not taxable. So what I want you to really remember from a compensatory damages is personal physical injury. Okay, personal injury. Personal injury is not going to be taxable. Why? Well, you had $100,000 in your savings account, and some jerk driving dangerously hit you and put you in the hospital, and you had to spend $70,000 to take care of yourself. But that person has to pay you back that $70,000. They're not going to tax you for it. That was a personal injury. It's simply reimbursing you for an actual loss that you had. That's a personal injury. Okay? That's why it's not going to be taxed. But what about emotional distress? Emotional distress are generally not going to be taxable. Why? Because they're normally associated with personal injury. Okay? If it's unrelated to a personal injury, they are going to be taxable. Mm-hmm. Don't make this complicated, though. This is where I want you to look specifically at the wording that I used on the federal income or not. So could you look at that on the right-hand column where it's not taxable under court awards? What does that say?
Personal physical injury.
Exactly. Personal physical injury. If it's personal physical injury, it's not going to be taxed. If it's emotional distress or emotional injury from a personal physical injury, it's not going to be taxed. If it's emotional injury from something else, it will be taxed. Okay? So the way to remember it is that right there. If you any type of award that you can plug into either one of the three on the left or the one on the right, if you get it into that category, then you know if it's taxable or not. So any questions about the court award and damages before I just jump on? Okay.
Okay.
Credit card insurance plans, what are those? That's where you can actually buy insurance through some, and maybe even all, I'm not sure, credit card companies. You get a credit card and they say, do you want to buy this insurance? Or actually, I think you can buy it from outside of credit card companies too. They say, do you want to buy this insurance against your credit card, so that if you've got $5,000 on there and you get hurt or really sick and can't pay it off, we'll pay it off for you and not charge you anything. Okay. Now, if you get one of those insurance plans and you end up using it and getting some payments from it, those are taxable. I don't even think I put that up there because it's so rare when I mean, I've actually never in real life doing tax returns seen one of these. Yeah, I don't have it up there. So, okay. So just know that those are taxable. Gifts and inheritances. What is a gift? A gift is when one person who's alive gives something to you, to another person that's alive. An inheritance is when somebody who passes away gives something to somebody who has survived that's still alive. Okay, so that's the difference between a gift and an inheritance. In most cases, property the taxpayer receives as a gift or an inheritance is not going to be taxable. So if I give you $10,000 as a gift, is that going to be taxable to you?
No.
No, it's not. If I put you in my will and say, okay, you're going to get from me $10,000 of my money when I pass away, and I do pass away and you get the $10,000, is that going to be taxable?
No.
However, if you take the $10,000 in either example and put it in the bank and earn interest on it, are you going to have to pay taxes on the interest you earn?
Yes.
Right. So again, that's because what I gave you, you consider old money. That's not subject to tax, but the interest is new tax. Same thing if you invested in stock markets and start getting dividends from it. The $10,000 you're not going to get taxed on, but you will get taxed on the dividends it's earned from it. If the gift or inheritance is income produced from the property, that income is taxable. In other words, you take the $10,000 and put it together with some other money to, say, buy a rental house that you use and as an investment. You got the $10,000 for free, but the income that it produces, rent, is going to be taxable to you. And then, of course, if you sell the property, it's going to be taxable to you. But you're going to have basis in that property. And that's where I refer you back to your that section we did last week on basis. Okay. Jury duty pay is taxable. You have to pay on it. There are times that a taxpayer is going to have to give the jury duty pay to their employer because their salary was still paid while they were serving on the jury. Okay. So here's the thing. It's always taxable, even if you got to give the money back to the jury, what am I trying to say? Even if you got to give the money back to your employer, it's still going to be taxable to you. So you still got to include it in your income. However, you get to take it as an adjustment, and you take it as an adjustment on your tax return, line 36. You just write it on there and take it on there. Okay. Veterans benefits, VA benefits. These are things that are paid under the law to the people that have served us in the military forces and or to their families for things such as education and training, for disability compensation and pension payments for disabilities, grants to help them get homes that are designed for wheelchair living, grants for motor vehicles that need special motor vehicles to help them get around. Veterans insurance proceeds and dividends, benefits under dependent care assistance program, death gratuity paid to a survivor, payments made under the VA compensated work therapy program. That's to help them do some work, basically to help them rehabilitate and go into another line of work. Any bonus payout by a political subdivision that's related to somebody serving in a combat zone. These are all just examples of VA benefits. Do not memorize these. Know this. It's real simple. If it's a VA benefit, it's not taxable, period. Other miscellaneous income. That includes Indian gaming profits. We're not talking about from gambling right now. I don't think we are. Yeah, we're not talking about from gambling right now. This is talking about like if you're a Native American and you're part of, you know, one of these, what what am I trying to say? Tribes that run casinos, for example, you're going to get a kickback from that casino because you're part of that tribe. Those are profits. That's income that you got to include. When you sell personal items, what is a personal item? What's another name for personal items that you use for personal use?
Personal property.
It is, that's true, but personal property is really a term that's used to designate it from real property. You can have personal property that you use in a business. What is personal use items called? We talked about it when we were talking about the sale of assets. Remember that? Assets.
The biggest one, guys, is think about something like a car.
Yeah, or a home. Yeah, you're right. You're right. Yeah, so personal items. Remember we talked about last week, we went through the section. Let me make sure I'm using the right terminology here so I don't confuse you. We talked about capital gains and losses. Personal property is a capital property. It's like a personal car used for your own use. Personal home used for your own use. If you sell those items, you're going to have a capital gain or loss. If you have a capital gain, it might be taxable. Remember, it's potentially taxable, and then you got to decide if there's if it's going to be subject actually to tax, like the sale of a home. Does that ring a bell with you guys?
Yeah.
Okay, so remember that you sell a home and you come up with a realized gain or loss.
Yes.
Now, a realized gain or loss, and then you determine whether or not it'll be subject to tax, gives you a what type of, what do they call it? A what gain or loss?
Recognizable.
Recognized gain or loss. That's right. Recognized gain or loss. So if you have a recognized gain, it's subject to tax. And that's what this is saying. Illegal income is subject to tax. I actually did a tax return for real of somebody who it kind of blew my mind, but they actually dealt drugs. That's what I discovered. They were trying to hide that from me, but it became obvious. They actually dealt drugs, but they were wanting to keep in mind what brought down Al Capone wasn't all of his other stuff. It was the fact he was not reporting his illegal income. That's how they got Al Capone. Well, this person knew that, and he said he wanted to do his return. So we did. It was kind of challenging to do it and not put him in a position, but I did it. He took care of it. The IRS could not come back on him at all for anything illegal because he reported and paid taxes on his income. So total income then is the total amount of income that's reported on 1040 lines 1 through 5 and Schedule 1, the top part of Schedule 1. So that's all of it. So just take a quick look at your Form 1040. You'll see lines 1 through 5, right? And then notice line 6 says add lines 1 through 5 and any amounts from Schedule 1, line 22. So that's all it's saying is you put all of your income either directly on the Form 1040 or on Schedule 1 of the 1040 and add it to what's on the 1040. That's how you come up with your total income, and you report that total on line 6. This total can include both positive and negative amounts. Remember if you have a loss on a personal, if you have a loss on a business, like you're a sole proprietor and you have a loss, remember that example? $20,000 income, other income, $5,000 loss leaves you with how much total income?
15,000.
15,000. And where on the tax return would you report that total? What line?
Line 6.
That's right. That's right. Now, there's one other thing I want to cover, but it's real fast here. We've been talking about regular income. We have not talked about any credits or anything yet, but sometimes when we have income, we have to make adjustments to that income for certain credits. A major one we make it for is Earned Income Tax Credit, also called EITC or EIC. Earned income for EITC does not include these things. Loss on a business. So we just, oops, sorry about that. We just talked about loss on a business. So if you have a loss on a business, what you did was you decreased your AGI by the amount of the loss. Well, if you're doing EITC, you have to add that back in. So let's take our example for a minute. We had $20,000 income from other sources. We had a $5,000 loss from a business. So our total income was, again?
15,000.
But for EIC purposes, how much income would we have to claim in that example? You do not, for earned income credit that we haven't talked about, other than I want to show you how income needs to be adjusted for different things. For EIC, you don't get to include the loss from the business. So what is the income for EIC purposes?
20,000.
20,000. You don't get to use that loss. Another thing, you don't include for EIC, you do not include scholarships or fellowship grants that are not already on the Form 10, the Form W-2. So scholarship and fellowship grants that are not on a W-2, you don't get to include income from that. Why? Because you didn't get, because you already got your tax break. That's why. If it was on a W-2, you got taxed on it. If it's not, you already got your tax break. That's why they're not going to let you use it for credit. Inmate income. So if you're an inmate in a penal institution or in a halfway house or something like that, you don't get to include that for earned income credit. But guess what? You still might get taxed on that income. Pension.
Guys, there is one type of income that actually, when you realize something, that we have state laws, especially like in Oregon and Washington, Colorado, that is a federal offense. We actually have marijuana and the sale of marijuana here in the States. So what will happen is, remember, that is technically on a federal return. That is an illegal income. So for the sale of it, and I've only actually had to experience it once, was a person reporting the sale of marijuana. And it does have to be reported on your federal income tax because it is a sale of a product. It is a business, and it is a business license recorded as a business in the state of Washington and in the state of Oregon. And according to federal law, it is an illegal substance. The same holds true even in Nevada. In Nevada, prostitution is considered legal, and in the federal statute, prostitution is illegal. So there are times when the state laws and how it's reported as an illegal substance or an illegal activity has.
Oops, Ryan, we just lost you. You just went on mute.
So, realize that sometimes the state laws, even though it sounds illegal to you, is not necessarily illegal to the states. The laws, right. Sometimes they sometimes contradict each other.
Yeah.
So sometimes even that inmate income, it may sound like it's something illegal, but it's not necessarily.
Yeah. Well, and that's absolutely true. In this case, though, this is what I wanted you to hear about the inmate income. This is from people working within the penal institution. They might be earning genuine income. What he's talking about is there can be a disconnect between federal law and state law a lot of times, and in which case you just treat each return separately. You deal with federal law separately anyway from the state return. And then you also have pension and annuity. We've already talked about retirement. These are retirement income from a non-qualified plan. Remember when we started out today, we talked about IRAs, traditional IRA, then Roth IRA, and then qualified retirement plans. Well, if you have income from a non-qualified plan, you don't include that in your income for EIC purposes. It would still be taxed to you, but because you got no extra tax benefits on it, you remove it from EIC. And then Medicaid waiver payments. This is when Medicaid is paying you to take care of somebody else in their home, and they're just paying enough just to help the person that needs help. It's not really for you to make a living. So these are things. Now, why do we throw it in here? Because now that we know what earned income is for tax purposes, I wanted you to be aware right now that there could be adjustments to that earned income for purposes of EIC and some other, as we go through this, there's going to be adjustments made at times to that. They call them modifications, actually. So these are truthfully, but the proper terminology is modification. You may modify income at times to make it match what they need for a credit. The one example here is the EITC. So do you want to know this? Sure. We'll cover it again under some EIC. All right. John purchased $25 worth of lottery tickets. At the end of the tax year, he received a Form W-2G reporting $1,000 in state lottery winnings in Box 1. This is his only gambling income for the year. How much of the winnings must he report?
What is in WG, Form WG?
975.
I'm thinking about what you said. It's $1,000, guys.
Oh, but he gets to deduct his $25
right.
cost, right?
How do they get it deducted? It's okay. Just think about this. You get it deducted by taking it as an itemized deduction. That's how you take gambling deductions. So gambling expenses you deduct as part of your itemized deductions if you itemize. If you don't have enough to itemize, you still include all $1,000, the entire amount. So what's the lesson learned from this question?
Include the whole amount.
Include the whole amount. That's right. And then later, if you can, take it as a deduction, the amount that you put into it. All right. Kim was on jury duty for 1 month and received $850 for her services. She turned this amount over to her employer, who continued to pay her monthly salary of $2,000 during her service. Should Kim's jury duty pay be entered on her tax return? Yes or no?
Yes.
Yes.
You guys are right. She has to include it all on there. Kathleen won a car valued at $15,000 from Miss Fabulous contest. Which is the correct way for Kathleen to report the car? And there's several listed here. Are you able to see it, Noemi?
No.
Okay. Let me know when it comes up. I want to give you a chance to do this.
It come up now. Kathleen won.
Okay, go ahead and read it and tell me what your answer is.
B.
Yes, you guys are correct.
Yeah.
Enter $15,000 as income, and where does it go? It goes on the Schedule 1, line 21. Yep, perfect. Now here comes the next question. Which item is generally not included in income? And I'll read these. Gambling winnings, are those usually included in income?
Yes.
Okay. Unemployment compensation, is that usually included in income?
Yes.
Canceled debts, is that usually included in income?
Yes.
Workers' compensation, is that usually included in income?
No.
So the answer is?
Workers' compensation.
Perfect. All right, here's another one. Which item is generally included in income? So life insurance proceeds paid directly because of the death of an insurance person, is that usually included in income or excluded from income?
Excluded.
That's exactly right. Workers' comp for an occupational injury, income or not?
Not.
Unemployment compensation?
Yes.
Income. Public assistance benefits, income or not?
Not.
No.
So you guys are 100% right. Unemployment comp is what's included. Ramona bought a new computer on sale for $766. It's usually priced at $1,000. She charged it on her credit card, but was not able to make any of the payments. The creditor canceled the debt and sent her a Form 1099-C with $766 in box 2. How much of the canceled debt should Ramona report?
766.
Yeah, 766.
You guys are 100% right. It's the amount that was actually canceled. Which item included in the amount on line 1 of Form 1040 does not decrease earned income for the earned income tax credit? So which of these do not count? Amounts received for works performed while at a halfway house? Do you make an do you make an adjustment for that? Do you make a modification for that from regular income for EIC purposes?
No.
For EIC.
I think I'm asking this all weird. Let me back up, okay? We're talking about a Form 1040, and it's asking which one does not decrease earned income for the EIC purposes. So we're having to determine what modifications do we make to regular income for the earned income tax credit. Do we make a modification for amounts received for work performed while at a halfway house?
No.
No.
Yes, you do. That's part of inmate income. So you would make a modification for that money. Okay? That's part of inmate penal work. Remember that one? Remember that exception?
I was having trouble following you on that, so okay.
It's okay. It's okay. Let's go on. Cash tips.
No.
It's okay. Let me do this. I think I'm going to back up just a second. There it is. What modifications do you make from regular income for earned income tax purposes? Remember, when you've got to have earned income to get earned income tax credit. So there's a definition of earned income for EIC. You have to modify your regular earned income. You have to modify your regular income that you put on from your total income that you put on your Form 1040. You have to make some modifications. You modify it by getting rid of any losses that were in there from a business. You modify it by any scholarships or grants that are not on a W-2. You modify it by inmate income. That's part of inmate income, a halfway house. You modify it by any pension or annuity income from a non-qualified plan. You also modify it by any Medicaid waiver payments. Does that make more sense what we're doing here?
You don't have combat pay on here.
Well, that has to do with you can choose whether or not to add combat pay to it. That's different.
Okay.
That's different. You can add combat pay to that. But look, we're ahead of ourselves here for those that don't know EIC yet. I even wondered about putting this in here, but it did make sense to introduce the idea that you can have total income on your tax return, but we have to make modifications to it periodically for different things. So those are the modifications. So let's get to the one that we want here. Okay, here it is. So what it's asking is which item included in the amount on line 1 of the Form 1040 does not, in other words, from your income, what does not decrease earned income for the EIC? Okay, I'm using the word modification. So 3 of these will modify EIC and 1 of them won't. So which 3 will modify income, earned income for the EIC credit?
Halfway house.
The halfway house, which is this one, amounts received for work performed while on a halfway house.
Medicaid waiver payments.
That's correct.
And the pension from a non-governmental Section 457.
Right, and what they're getting at is it's a non-qualified plan.
Yeah.
What will not decrease it? Cash tips. Well, obviously cash tips won't, because cash tips are part of your income. You get to use that as part of your earned income for EITC.
Yes.
And that's it.
Okay.
And that's it. So I hope this has helped. That's everything we have for today. How are you guys feeling about all of this? You feeling confident with this material, today's material?
Yes.
Yeah.
Are you really? I mean, it's okay if you're not. I kind of got to know so I can decide where to go from here. But
I feel fairly confident in it. Yeah.
okay. Okay. All right. Well,
Hey guys, that last question, I know it was a little bit confusing the way it was written, because it's worded as to which does not affect your EITC, or which does not count against it, which does not decrease it. You have to think about it this way. What it's really asking is, which one is earned income? Okay, so when you're reading a question like that, make sure you know kind of what they're looking for. So if you read the question really carefully, and what they're asking for is out of that list, which one counts as really earned income? Okay, and cash tips is always earned income.
Yeah.
So if you look at it that way, you know the others don't necessarily count as earned income in that sense.
He's
So,
Ryan's making a good point. It's just another way to look at a question, and you're going to get some of these questions. I've thought. I mean, I'm toying with the idea of changing up that question for you, but I don't think I'm going to, because
the test may ask you a question like,
well, yeah, you need to learn how to handle some of these weird questions like that. It is weirdly worded. I didn't write that, but the fact is you may get one of these that are sort of a double negative question, which is what you had there. Which ones don't? Well, all these are not to be included. You got a double negative. Simplify it, just like he said. That was a great piece of advice. Okay, so tomorrow, or excuse me, not tomorrow, the next session, we're going to be taking 2 sessions to go over 3 chapters in your reading. The 3 chapters in your reading you are going to want to go into are chapters 11 through 13. Mm-hmm. So chapters, or I keep forgetting what they call them. They call them units 11 through 13. So okay. Units 11 through 13 are what we're going to start covering next, but we're going to take 2 sessions to do it. We're going to take 2 sessions, not because it's hard, just there's a bunch of information there and I don't want to rush through it. We're going to initially start, though, with adjustments to income. Remember from our big picture, at the very first session, we went over income, total income minus adjustments gives you AGI, right?
Yes.
And then minus deduction gives you taxable income. Well, we're going to start talking about those adjustments first, and then we're going to talk about those deductions in that formula. So that's where we're moving to in the Form 1040. And I don't know exactly how much we'll get through, but we'll get through some of it, and then we'll pick it up with the following session. So that's what we're working on for the rest of for the next 2 sessions. So any questions or comments or concerns that you want to bring to my attention before we call it quits for the day?
No.
Okay. Garrett?
Yes.
No, I'm good.
Okay. Most excellent. Thank you, everyone. We'll see you on the next session.
Thank you.
All right. Bye.
Bye, guys.